Welcome back to the afternoon session of our December 4, 2025 Investor Advisory Committee meeting. Adam, do we need to note if any IAC members have joined or departed as we're returning to the public session?
I'll just note that Christine Lazaro did join us after the roll call.
Thank you. Our afternoon session begins with our second panel, Tokenization of Equity Securities, which will be moderated by Andrew Park and John Gulliver, followed by a discussion of our potential committee recommendation, as well as remarks from Commissioner Ueda. Andrew and John?
Thank you, Brian. Our panel today is on the tokenization of equities. And so following the May SEC roundtable that raised many important issues around tokenization, this panel looks to dive deeper into the issues around the issuance, trading, and settlement of publicly traded stocks. So for starters, for those who are not familiar, what is tokenization? Tokenization is the issuance of a token representing ownership of an asset over a blockchain. And in a moment, we will hear from our esteemed group of panelists how the innovation around these tokens and the blockchain could be used to improve how equity trading is currently conducted. This panel will also help us answer what activities, despite using digital tokens and blockchains, are still functionally similar to what we have for existing entities, many of which we have laws and regulations that have been long accepted and understood by many market participants. And this framework has really helped the US capital markets to become, by and far, the most preeminent market in the world. At the same time, we will also hear where those rules may need to be updated. Equity trading has certainly come a long way from the days that a group of gentlemen gathered under a buttonwood tree in downtown New York to trade stocks. And also, we have come some ways away from the days when delivery agents were literally people who would carry bags of trade tickets for physical settlement at DTC. And as we think about this, we think about how back in the 1980s and going into the 90s, we saw this original rise in electronic trading that would later pave the way in 2005 for the adoption of Reg NMS, recognizing that these new technological advancements to equity trading were something to be worth thinking about, but at the same time, still making sure that the efficiency, fairness, and transparency still existed in the markets. So at this moment in time, when it comes to tokenized equities, we have a number of questions that we need to answer for ourselves. One of which is, there are many different issuance models that currently are out there in place. So leading us to ask, what is it that investors own and what are their rights associated with what they own? There are also different ways that tokenized equities can be traded, whether through centralized exchanges or through peer-to-peer methods. And we will start to look into all of these different issues. Let me now turn it over to my colleague on the committee, John Gulliver, who will outline what we hope to accomplish with this panel today.
Thanks, Andrew. Can you hear me okay? Yeah, good. Great. So our goal for this panel is to stay high level. We don't want to get bogged down in the weeds of technical details. I think tokenization can get very complicated very fast. What we want to learn from our panelists is where the tokenization of equity stands today, where they think it is going in the future, and we want to learn about the major opportunities and the risks that tokenization of equities presents for our markets and for our investors. And I think most importantly, we want to know their view on what policy actions, if any, the SEC should take now with respect to the tokenization of equities. Ultimately, our goal is that this panel will help inform a potential IAC report or recommendations on this issue that would provide clarity on the policy issues posed by the tokenization of equities. Just a little bit of housekeeping. Also, we have 6 panelists. We've asked that they speak for about 5 to 7 minutes each. That's going to take up about 40 minutes of our time, and that will leave us about 80 minutes for discussion. And we're going to break that up into 3 different sections. We're going to begin with about a half hour on issuance, then about 40 minutes on trading, and then a briefer discussion about 20 minutes on settlements. So that's going to be their structure, and there'll be plenty of time for Q&A, and we think that'll be a very important part of the session. So with that, let me turn it back to Andrew to take us forward.
Great. And so leading us off in this discussion, I want to introduce our first panelist who recently is part of an organization that submitted a proposal with the SEC in September around what tokenized equities could look like. And so our first panelist is going to be Chuck Mack, who is the Senior Vice President and Head of Strategic Operations and Public Policy at NASDAQ. Let me turn it over to you, Chuck.
Thank you, Andrew, and thank you to the committee and John as well for putting this great panel together and for including me, giving me this opportunity to join this really important discussion. Today's conversation is really about the future, and that is the evolution of the U.S. capital markets, and specifically how tokenization can unlock value for those markets. At NASDAQ, we've always believed that market innovation has to prioritize liquidity, transparency, and integrity as foundational principles to ensure that any innovation brings benefits to issuers and, of course, investors. We share SEC Chairman Paul Atkins' vision articulated in his speech from November of 2025 at the Federal Reserve Bank of Philadelphia. And to quote here, "Our goal at the SEC is to facilitate capital formation and accommodate innovation while at the same time ensuring investors are protected." We couldn't agree more. With this framing in mind, I'd like to talk about our markets and why tokenization represents such an interesting opportunity. Everyone knows the U.S. capital markets are the envy of the world. They represent nearly $70 trillion in market capitalization. We average about $800 billion traded every single day. Our markets are the engine of innovation and growth, providing capital to businesses. In fact, so far in 2025, that'd be around $200 billion that's been raised for companies to invest in their people, factories, and technology to deliver innovative solutions and grow our economy. Our markets help build wealth and financial security for everyday Americans and their families. This foundation of strength positions us perfectly for the next evolution. Tokenization has the potential to enhance how the markets operate today. This technology offers exciting possibilities like faster settlement, enhanced operational efficiency, and programmable compliance, just to name a few. NASDAQ's always been excited about market modernization, and it's something you've probably heard us say many times. And as Andrew said, I was thinking it was 3 decades ago or so, the markets were becoming more electronic and automated. We saw the benefits that this could provide to issuers and investors. We also saw that as technology advances, it's essential to continually assess and update our rules and regulations to encourage innovation while still safeguarding investor protections and maintaining market integrity. To talk a little bit about the proposal Andrew mentioned, what we're proposing in regards to tokenization is straightforward and represents what we think of as a first step in a multi-step evolution. And we're seeking to bring everyone along with us, one step at a time. Our proposal would enable member firms and investors to trade tokenized equity securities on our market, and we'd leverage the Depository Trust Corporation, or DTC, for clearing and settlement. We believe this solution, like I said, this first step, is elegant in its simplicity. It recognizes that the changes required to accommodate tokenized security largely sit with settlement and clearing processes. Under NASDAQ's proposal, tokenized shares would maintain the same CUSIP, the same rights and benefits, and the same execution rules. In other words, it represents the exact same shares as you would expect from today's structure. This approach harnesses blockchain technology while leveraging the benefits to investors of our national market system, including but not limited to robust price discovery, transparency, and best execution. We're working to collaborate closely with the SEC and industry participants to ensure interoperability with existing data and trading protocols and to optimize execution quality across all formats. This is why we follow and appreciate the public notice and comment process, so we can hear the industry's reactions to our proposal, and so really, frankly, everyone can hear, and we can move forward in a collaborative and thoughtful way. We see the tokenization of securities as not only something that can be built within the existing frameworks and guidelines of the market, but also something that should be. That's why this proposal is an important way, in our view, to bring tokenization to market. It will allow this technology to evolve and be embraced, but also ensures that investor protections that I've mentioned a few times that we've built up over multiple decades will stay intact. So before I hand it back to Andrew, I just want to leave you with three things. First, our markets are strong and resilient. They are the global benchmark of efficiency and trust. If done responsibly, innovation like tokenization can enhance these strengths. Second, innovation and investor protection are not competing priorities. They are complementary. Blockchain technology has the potential to augment transparency, auditability, and security when implemented thoughtfully. We can unlock value while strengthening trust and resilience. We can use past lessons learned to guide us. Together, we can create a future that provides the benefits of tokenization without exposing the markets to undue risk. And lastly, the U.S. can continue to lead global innovation, including in this area of tokenization. Technology is there, the infrastructure is being built, and in our view, the future is bright. Thank you, and I'll hand it back to you, Andrew.
Thank you, Chuck. Next, we will hear a little bit more about the various different models of tokenization that are out there right now. So I'll turn it over to Coy Garrison, who is the Senior Director and Deputy General Counsel of Crypto at Robinhood. Coy.
Great. Thanks, Andrew and John, the rest of the members of the committee. Earlier in my career, I had the pleasure of working at the SEC for Commissioner Hester Peirce and in multiple roles of the Division of Corporation Finance. So I have many fond memories working with this committee, and it's a real pleasure to be here to aid in your important work today. The U.S. equity markets are the most liquid and efficient in the world. Preservation of our treasury capital markets is therefore an appropriate cornerstone of the SEC's mission. However, maintaining fair and orderly markets does not mean that we must settle for the current way of doing things. When transformational technologies emerge with the promise of new efficiencies and benefits, the SEC must work with market participants to allow experimentation and to tailor regulatory frameworks to allow responsible innovation to flourish. At Robinhood, we believe that tokenization is a transformational technology that will consume the entire global financial system. Specifically for the US, tokenization presents a generational opportunity to both modernize and dramatically enhance legacy market infrastructure. Allow me to highlight a few benefits of the technology that can improve upon our current structure. First, tokenization can enhance transaction settlement. Near instantaneous settlement would reduce operational costs and risks for intermediaries and consumers. Second, tokenization allows for 24/7 trading and improved price competition for tokenized equities with low trading volumes or private stocks. Third, programmability of tokenized equities would aid compliance with a variety of regulatory requirements, including transfer restrictions and KYC and AML requirements. Programmability can also streamline implementation of corporate actions and proxy voting. Reducing administrative costs and the number of human errors present in these current processes will benefit issuers and investors alike. Fourth, tokenization allows for fractionalization, potentially enhancing access to securities priced at levels out of reach for certain investors and facilitating deeper liquidity for less liquid stocks or private stocks. And fifth, tokenization of private stocks, if coupled with reforms to the accredited investor rules away from the current wealth-based requirements, would reduce financial barriers to entry and allow for a more democratized access to investment offerings, which is a principle that is core to Robinhood's business. Realizing these benefits will require a tremendous amount of work and collaboration between the industry and the SEC over a period of years. We are fully aware that the benefits of tokenization will not be realized overnight. However, that should not stop incremental experimentation by regulated entities, aided by transparent and clear regulatory flexibility afforded by the SEC. The many issues associated with the issuance of tokenized securities demonstrates why an iterative approach will be necessary as market participants and the SEC work out the operational and regulatory issues to be resolved. The first issue to address in this context is what is the nature of a tokenized equity? The answer to that question defines the rights afforded to investors and should dictate how the token is regulated. Commissioner Peirce said it best when she said tokenized securities are still securities. This is perhaps most obvious in the context of the native issuance of equities on-chain by an issuer. In other words, a tokenized book entry security is indeed a security. While some issuers have experimented with this model, there's a bit of a chicken and egg problem. Many issuers are discouraged from pursuing this path because the infrastructure for and regulation of secondary trading of these equities is not mature. Prior leadership at the SEC discouraged market participants from interacting with any digital assets, including tokenized securities. We are encouraged by the SEC's current approach, including the Division of Trading and Markets FAQs relating to crypto asset activities and distributed ledger technology. Of course, further guidance would be welcome. It would be helpful for the SEC to confirm that for purposes of the net capital rule, for example, tokenized securities can be treated in the same way that traditional equity securities are. Additional clarity that participants in the underlying blockchain's consensus mechanism are not subject to clearing agency and transfer agency rules would also be helpful. Additional regulatory and operational hurdles exist as well. For example, issuers need to confirm whether their state law and their place of incorporation permits the company to administer its stock ledger on-chain. Additionally, market participants need to determine whether traditional financial intermediaries or new entrants can effectively provide on-chain services in a compliant manner, including underwriting activities, processing corporate actions, recording beneficial ownership, and facilitating proxy voting. Native issuances have the benefit of affording investors the full bundle of rights associated with equity ownership. However, it will take a long time for a critical mass of issuers to make the decision to switch to native issuance and to work through these issues. A second model is often referred to as the wrapper model. Many variations, of course, exist. Typically, it involves a third party that custodies traditional securities at a broker and issues tokens tied to the securities that it holds. The issuer may choose to pass on all legal rights to the token holder, or it may choose to pass on only certain rights, such as dividends. If offered to U.S. persons, these wrapper tokenized securities should be treated as what they are, either securities or security-based swaps, depending on the particular facts and circumstances. With respect to any concerns regarding investor confusion about what exactly they hold through such tokens, existing disclosure obligations and suitability requirements should be sufficient to ensure that investors understand the nature of their holdings and the attendant risks. Notably, the wrapper model depends on the continued existence and vibrancy of the traditional equities market structure. By adding a token layer to an already complex structure, the full benefits of tokenization may not be realized. That is not to say that such a model has no value. Robinhood is using a wrapper model in Europe to give customers in the European Economic Area the opportunity to gain access to over 700 U.S. public companies and ETFs. Now, to be clear, this product is not available to U.S. persons. The stock tokens are derivative contracts under applicable European law between Robinhood Europe UAB and the customer. Each token issued represents an economic interest in one share in the underlying U.S. listed security. European investors may buy in at the price of the underlying asset at the time of purchase, and they may sell out at the price of the underlying asset at the time of sale. Dividends and corporate actions are passed on by Robinhood Europe UAB to eligible holders of stock tokens in a corresponding amount of cash. Now, what works well for the European market may not work well for the US. Each jurisdiction has its own bespoke regulations and market-driven realities that will shape how tokenization will look. However, the progress of tokenization in Europe and the rest of the world should serve as a nudge to the US to encourage experimentation by regulated entities in tokenized equities in order to maintain its competitive edge. Conversations like the one today are a step in the right direction. I look forward to discussing more specifics to both issuance, trading, and settlement during our conversation. Thank you.
Thank you, Koi. And certainly we will be spending a fair bit of time thinking about those issues you just raised. And so next, I'll turn it over to Alex Thorne, who is the head of firm-wide research at Galaxy Digital Holdings. In addition to being an investment firm focused in this area, Galaxy Digital also recently issued a set of shares, a tokenized version of shares, I should say, recently. And so Alex will talk us through what that all looks like. Alex.
Yeah, thanks, Andrew, and thanks to the committee for having me. I am Alex Thorne. I'm head of firm-wide research at Galaxy Digital. Galaxy is a digital assets and data center company serving institutions through trading, asset management, and high-performance compute for AI. We are publicly traded on the NASDAQ under the ticker GLXY, and as of August 2025, as Andrew mentioned, we became the first NASDAQ-listed company to tokenize our own stock on a public blockchain. Today, shareholders can convert traditional shares into tokenized versions on the Solana blockchain natively issued by us, not wrapped in an SPV or other synthetic structure. on-chain shares of GLXY carry all the same legal, economic, and governance rights as traditionally formatted GLXY. Many tokenization models will emerge, but we believe that only issuer-originated tokenization reflects true public company equity on a blockchain, and that's the standard we're advancing with our own tokenized GLXY. Public permissionless blockchains are not speculative toys. They are infrastructure. They deliver transparency, predictability, censorship resistance, and global access at a scale that no centralized system could ever match. Millions of Americans already rely on Bitcoin to preserve and transmit value through these properties. The same technology can materially improve how public equities are issued, traded, and settled. We believe that enabling public equities to function inside decentralized finance applications will be the most consequential capital markets innovation of the last 20 years. Why? Because decentralized systems provide what investors and regulators have always sought: transparent rules, neutral execution, lower costs, and fairer access. Tokenized securities could broaden investor participation, compress fees, accelerate settlement, and strengthen capital formation. Will every benefit materialize immediately? No. As far as I know today, Galaxy stock is the only tokenized US-listed equity, maybe one or two others. But we must have the freedom to learn empirically what works. That's why we commend the Commission and Chairman Atkins specifically for considering innovation exemptions that allow responsible exploration before formal rules are written. Markets cannot innovate under total prohibition, but we also need more information about how this technology may be used by the market before comprehensive rules can be written. And I want to be really clear. We are not advocating for a future without rules. Participants in issuance, trading, and settlement may need to meet existing obligations or new ones. But many of the securities rules and laws were drafted with an unspoken assumption that investors could not transact without intermediaries. Public blockchains fundamentally challenge that assumption. Today, there exist decentralized systems that operate autonomously without a controlling group and whose transparency prevents theft, favoritism, market disruption, and hidden fees. These protocols embody principles that regulators have spent decades trying to enforce through oversight alone. Predictably, not everyone welcomes this progress. Some entrenched intermediaries are fighting to preserve regulatory moats under the banner of investor protection. In many of these cases, they are protecting their margins and not investors. Some have even proposed that software developers should register with the Commission, a notion that is not only unworkable, but is also profoundly disturbing. You will hear supporters of the status quo call for years-long rulemaking, for applying outdated frameworks to systems they were never designed for, or for procedural hurdles meant only to delay competition. Those are not about investor safety. Those are about incumbents shielding themselves from innovation. Galaxy believes in responsible innovation because it has always strengthened American markets. The United States leads global finance precisely because we've embraced technological change rather than feared it. No one wants to undermine market integrity or investor protection. Instead, we seek to enhance it with tools that deliver better transparency, better resilience, and better outcomes for investors. Chairman Atkins recently invoked the 1960s paperwork crisis in a speech in July. Back then, markets were expanding faster than the infrastructure could support. Brokers lost physical certificates, failures skyrocketed, and exchanges had to close early to give everyone more time to reconcile their books. A quarter of brokers went out of business during this period. That crisis led to the creation of the DTCC ultimately, a centralized system designed for a paper world that no longer exists. Human beings naturally prefer peer-to-peer interaction, but at scale, we default to centralization because we lacked the technology for trust-minimized coordination. Central intermediaries can be efficient, but they also require deep regulation because they can, intentionally or not, steal, preference, or cheat. Public blockchains and decentralized software cannot steal, it cannot preference, and it cannot cheat. That is not a marketing slogan, it's a structural property ensured by code transparency and distributed consensus. And it is a profound innovation. It's why regulators should permit controlled experimentation rather than assume that the old architecture must forever dictate the new world. We commend the Commission for its willingness to explore this frontier, allowing innovation to proceed carefully, responsibly, and transparently is the only path to understanding how these systems can strengthen U.S. capital markets for decades to come. Thank you so much for the time, and I'm looking forward to the conversation.
Thank you, Alex. Next, we will hear from Jonah Platt, who is a Managing Director and U.S. Head of Government and Regulatory Policy at Citadel Securities. Jonah.
Thank you for having me today as part of this important discussion. Citadel Securities is the leading market maker in the United States, delivering exceptional execution quality to our clients. Over the last decade or so, innovation has dramatically lowered trading costs for all investors, further cementing the U.S. equity markets as the gold standard globally. Let me be clear. We believe that tokenization of U.S. equities represents another promising innovation that has the potential to further benefit investors. Benefits can include the ability to self-custody assets and transfer them 24/7, further reductions in settlement risk, and more efficient shareholder communication. These would deliver valuable benefits to investors if achieved, and we are actively partnering with key firms in the digital asset space to do just that. We are excited for what the future holds. Today, we've been asked to speak a bit about tokenization structure, trading, and settlement, and I have a couple of slides to walk through, so we can go to the first slide, please. Is someone on the committee running the slides?
Adam, can we load the slides? In the interest of time, Jonah, do you want to talk and we'll hopefully get out there?
We're sideways, but. Okay. Hopefully we can get that straightened out, but I'll continue on. So talking first about tokenization structure. So as you can see on this slide, there are three main structures for tokenizing U.S. equities that are being discussed. The first is direct issuance. We've heard a little bit about this already today. This is where an equity issuer uses a blockchain to maintain ownership records of some or all of its shares. The second option is a digital receipt. This is where a third-party firm immobilizes existing shares and issues digital custodial receipts on a blockchain. These receipts may be structured so that they are considered to be the same security as the existing shares, meaning there's no separate instrument to register. As a result, when an investor transfers the digital receipt of Apple shares, for example, they're considered to be actually transferring the underlying Apple shares. And then the third option is a derivative. This is a new instrument being created that is linked to the price of the underlying U.S. equity. I'll highlight 2 points for now. First, the derivative version, while available offshore, appears challenging to market to U.S. investors, and this is because security-based swaps must be separately registered with the Commission if offered to retail investors. Therefore, for today's discussion, I will focus on the first two alternatives. Second, with respect to those first two alternatives, there are important differences that merit consideration, including the level of issuer involvement and fungibility. And investors should clearly understand those differences and the specific characteristics of a tokenized equity. Now turning to trading, we can go to the second slide, please. Perfect, thank you. So once a tokenized equity is created, either via direct issuance or a digital receipt, there are broadly speaking two ways to trade it: through commission-regulated market centers, such as exchanges and ATSs, or through what are being called decentralized or DeFi trading protocols. There are a couple of points to make here. First, many of the key potential benefits of tokenized equities, such as those that I mentioned earlier, can be achieved when trading the instrument on an exchange or an ATS. And there are multiple live initiatives to do just that, including the NASDAQ proposal that we heard about earlier. Therefore, it is important to clearly establish the incremental benefits of trading a tokenized equity via DeFi. We often hear that DeFi enables transactions to occur on a peer-to-peer basis without intermediaries, such as registered brokers, dealers, and exchanges. However, at the same time, we see requests for the Commission to grant broad exemptive relief to DeFi participants from the statutory definitions of a broker, dealer, and exchange. This suggests that there may be intermediaries involved in DeFi trading protocols, and at least this particular asserted benefit hinges on the Commission granting exemptive relief from otherwise applicable registration requirements. Second, were the Commission to grant broad exemptive relief from the statutory definitions of a broker, dealer, and exchange, This would have significant negative consequences for investors. This is because nearly all of the Commission's substantive investor protection requirements apply only when a registered intermediary is involved. The implications go far beyond Reg NMS. Without registered broker-dealers, there would be no best execution requirements, no prohibition on front-running, and no standardized execution quality reports. In turn, without registered exchanges, there would be no market-wide transparency requirements, no market resiliency measures such as price bands and trading halts, and no market surveillance requirements. In essence, there would be a segment of the U.S. equity market that would operate entirely outside of the regulatory framework that has been carefully crafted by the Commission over decades to protect investors and safeguard market integrity and resiliency. In our view, thoughtful regulation is a key reason why U.S. markets are simply the best. Of course, further improvements can and should be made. If specific rules do not make sense for tokenized equities, then they should be reviewed. And we have published a white paper putting forward a number of recommendations designed to further enhance U.S. equity market structure that would apply to tokenized and non-tokenized U.S. equities alike. In our view, these approaches should be pursued rather than simply granting blanket exemptions from all registration requirements. We can close the slides, please. Let me close with a few words regarding clearing and settlement. First, it is important to acknowledge the significant progress in this area. We applaud the Commission's leadership in successfully transitioning the U.S. equities market to T+1 settlement, which has unlocked greater capital and operational efficiencies. We strongly support initiatives designed to further improve clearing and settlement efficiency, and tokenization certainly has the potential to do so. We look forward to partnering with the Commission and market participants to explore those opportunities and achieve concrete results for investors. Thank you.
Thank you, Jonah. Next up, we will hear from Scott Bauges, who is the Vice President of Global Regulatory Policy at Coinbase. Scott.
Yeah, Andrew, thanks. Thanks to the IAC for having me here. It's great to be speaking in front of the SEC. In fact, I left in 2019, and this may be the first time I've done an event with the SEC since then. So glad to be back. It was 4.5 years ago that I first started working in crypto. I had returned to academia and I started working with Coinbase. And that's what I learned or recognized the first time that markets are electronic. You can trade in a picosecond, but they're not yet digitally native. And that's what's about to happen now. It's in the process. And that's very exciting. And up until this prior year, when it came to securities, the world was really focused on sandboxes and simpler securities, debt instruments. A lot of great work was done with funds. But now we're focused on Reg NMS securities. And if we can solve the trading of issuance and trading of digitally native Reg NMS securities, then we can solve it for any asset. And that will pave the way for the entire financial market. So it's a very exciting moment. I think a lot of focus, rightly, is being placed on trading. How do you treat a DEX, a decentralized exchange, and a decentralized finance environment that's pure code without intermediary? And some of the panelists have already talked about that. Sometimes this is still being called so-called DeFi, believing that maybe it is intermediated or not disintermediated. But genuine, true DeFi in a DEX, something like a Uniswap protocol, offers a tremendous amount of promise and can offer a lot of productive disruption to traditional trading methods. And so when it comes to DEX trading, and some have already said this, but I'll repeat it, there's nothing more transparent than a blockchain. A DEX, a decentralized exchange, natively accomplishes many of the investor customer protections that current regulation is aiming to do. It's deployed on a blockchain. There is no constituted or maintained, it's not constituted or maintained by a single organization or group of persons. The trading rules are all public. They're embedded in the code. There's no party can exercise discretion or control. It's transparent. It's free and public display of all pricing. There's no consolidated tape to pay for. It is non-custodial. No intermediary ever takes custody of a trader's assets. There's fair access. It's permissionless. All liquidity providers and seekers are subject to the exact same rules, and there are transparent fees. All fees earned by a liquidity provider or otherwise paid to the protocol are determined by its governance and or its participants. And what's really interesting is that when it comes to market surveillance, everybody in the market can see in real time what is happening. A lot of people are talking about the October 10th event. And what's interesting about that event is that the whole world within 24 hours knew exactly what happened and where all the flaws in the system were at that time. And if you think back at any regulatory event in the past or a flash crash, it was weeks before a regulator could get on stage and said, here's what happened or here's what we think happened. On-chain solves a lot of the regulatory issues and surveillance challenge issues that currently today are impeded. Now, trading is important, but I think where the true promise of blockchains and securities on blockchains is with issuers and capital formation. Firstly, and importantly, it's going to expand access to U.S. equities to international markets. It's expensive for foreigners to get access to our markets. Some can't get it at all. And expanding access globally means a lower cost of capital to all the issuers of securities on chain. That's extremely important and shouldn't be dismissed. Second, the programmability of corporate actions, and then Coy did a good job of talking about that. The Commission for decades is trying to figure out a way to get investors to be registered shareholders and not beneficial owners. It's easier for investors to participate in corporate governance when securities are on chain. They can have direct access or relationship. Issuers can have direct relationships with their investors. You can pay dividends and vote on chain. This is going to solve many of the proxy plumbing problems that the SEC has grappled with for decades. Also, I think it's very important that on-chain securities is going to give new life for the offering exemptions like Reg A and crowdfunding. The reason these offering exemptions have never met the promise and hope when they were issued is that the liquidity is a missing piece of the equation. Smaller issuers don't have access to liquidity on a national stock exchange. And if you issue securities on chain that have access to a DEX, all of a sudden you now have changed a market where either you have as much liquidity as you need or none at all. Startups will be able to find new investors. Investors will be able to find new startup companies. And ultimately, why this should be attractive to national stock exchanges, it's going to increase the top of the funnel and incubate companies that ultimately can list on an NSE. And finally, I will just say that going on chain will give investors sovereignty over their assets, like was always envisioned ever since the buttonwood tree, but because of where technology has landed us today, has largely taken that away, trading through a broker. Brokers are not going away. I will continue to always use a broker, but there are many people in this market who would like to have self-sovereignty, self-custody of their assets, have portability of their assets, be able to lend their assets in DeFi protocols, and that offers a lot of hope and promise to innovation in this market. And I had a whole talking point on why the SEC should pursue the exemptive path in parallel to rulemaking, which I think is the path they're on, given the chair's remarks earlier. And so I just want to echo that that is the absolute right way to do this. We saw that with ETFs. Exemptive orders were issued in the 90s. The market was allowed to develop, and it wasn't until 2 decades later that rules were written. Same with ABS issuers. Exemptive relief was given to ABS issuers, and ultimately rules were written in Regulation AB. And all we're doing here, securities are securities, like Commissioner Peirce said, all we're doing is applying to new technology, and now is the right time to carve out specific exemptions to existing rules to allow securities to trade on chain. I'm done, Andrew.
Thank you, Scott. And finally, to round us out, we will get the both an investor perspective and also a tokenized issuer perspective from Samara Cohen, who is the Senior Managing Director and Global Head of Market Development at BlackRock. Samara.
Thank you so much, Andrew. And just to echo the other excellent panelists, a huge thank you for the time the committee and everybody listening is investing by putting 2 hours into this. On our prep call, I thought, wow, there are 6 speakers. That's a lot for a panel. And I realized, having listened to everybody, that it's actually pretty helpful given the distinct paths and perspectives underway. But that tells you something about the challenge of the moment that we're in. and the fact that there's probably more than one solution to it. So many of, I think, the critical points have been made, and I know we're a little bit over time and want to get to discussions. So I'm going to try to weave together and play back a couple of the threads as I hear them from an investor's perspective, and what I think the path forward is. The first is just to take a step back, like, why is this important, and what does tokenization, particularly in a market as highly functioning as US equities, what's the utility here of tokenization? And I think it is really three parts. And again, the different panelists here have said this in different ways, but for me, the simple way to break it down is, number one, access. Tokenization can create access where there wasn't before. Now, in a market like US equities, it's a pretty accessible market. So if you had told me 2 years ago we would be spending this time on US equities, it probably would have surprised me, thinking that applications of tokenization would be more interesting to things like private markets, things that are harder, less liquid to trade. And I think that Scott made an excellent point that actually looking at US equities in a functioning market helps us in a number of ways, as opposed to trying to solve several dimensions of issues that come with less liquid assets. But I think with respect to US markets, and I think Scott also made this point, they're very accessible to US investors, but there is increasingly demand for US equities from non-US investors, and importantly, for US equities from digital native investors who have been primarily invested in cryptocurrencies, which particularly in the current market environment is a moment to think broader diversification and traditional public securities. So that's the access dimension. But it's actually the other two dimensions that I think we really have to think about. The second one being utility. Does this technology allow us to do something with the security that we can't in more traditional forms? And a number of those things were raised with respect to settlement efficiency, 24/7 trading, fractionalization, and harnessing DeFi protocols that permit other trading modalities. And the third is simply cuts costs out of the system, and then by extension delivers better returns. So I think from an investor perspective, the opportunity here is clearly profound. But again, I guess one thing I take a little bit of pause on is this notion that innovation and investor protection are always complementary, because I think the risk is, again, in a market as highly functioning as the US market, what is the innovation delivering? And how do we calibrate that there is a measurable investor benefit to accept some of the uncertainty that comes with trying to onboard a new technology into a highly functioning and developed system like US equity markets? I think as we talk through the models, and I do appreciate that only one of us had slides, but I think it is helpful to think about this issuer native, the issuer-led, third-party, and derivative constructs. And to be clear, with the exception of the derivative type products that are currently live in Europe, these are all kind of PowerPoint models right now. So we really don't have market experience of engaging with them, pricing them, and most importantly, determining impact on market integrity and interoperability of these models. And I think we can go through and craft out potential use cases. I'm quite sure we can go through and craft out potential use cases for several of these models, but ensuring they can operate in parallel without undermining price formation and market integrity ultimately requires some concept and mechanism of productive arbitrage and interoperability. How do you price the difference between two in a transparent way so that it's clear if they do have different prices that is appropriate? They have different counterparty characteristics, liquidity characteristics, utility characteristics. those things will accrue to different economics that an investor has to be able to appropriately price. So I think, and I will end with this, considering the experience we've had in US equity markets with ETFs and how ETFs create redeem mechanisms to ensure alignment of ETF trading with the underlying portfolios, I think we have, and there's other examples of this, but some mental models to help us assess how we can introduce new wrappers and maintain appropriate price formation across those different wrappers. So I'm very much looking forward to the conversation and the questions, and mostly I think the opportunity. I think the history of markets tells us that markets evolve in the most impactful way when new technologies and regulation meet to create this appropriate calibration, which requires exactly conversations like the ones we're having together here today. So thank you very much for having me, and I will close there.
Thank you, Samara, and thank you to all of our panelists. Just some housekeeping items before we transition into the discussion portion. For those who are watching, the SEC Investor Advisory Committee has a comment file, and so you don't need to be a participant on this panel to have a voice on it. You are free to submit a comment of the comment file, which is live, and staff are standing by to take those submissions. As John outlined, we will be breaking up the discussion into 3 parts. We'll first start talking about issuance. And so if folks on the committee could, who have questions, focus questions on issuance. And then after some time, we will then talk about trading and then settlement. And you can either raise your hand or put your questions in the chat. And so first question to our panelists. So we've outlined the 3 major different models that are currently in existence, whether we're talking about the native issuer-owned, whether we're talking about the a wrapper, or the third model being the derivative model. And so one key question is ultimately, I mean, because we had a panel 3 months ago that in a different context was looking at questions about ownership in terms of foreign private issuers. That panel looked at structures such as variable interest entities and also ADRs, where frankly we were hearing many different answers about what it is that that investors actually own and what are the actual rights associated with that. So bringing it back now to tokenization and the different models that we just heard about, the question is, how does an investor, what is the best way for an investor to know what it is they actually own and what are the actual rights that they have with that? Do any of the panelists have some thoughts as to how investors could be best informed about that?
I mean, I can start. I'm sure various folks have thoughts on that. I think 2 points I would make. One is the disclosure rules. I think Coy might have mentioned it. The disclosure rules that exist, are important, and it's important that it's clear. And so the investor has to essentially be told, this is what you're buying, this is what it means, this is what it doesn't mean. And I think that the challenge there is, one, making disclosure simple enough that people actually read it, which is hard. I know I get notifications from various entities that I don't read because they're really long. So that is a challenge, but also written in a way that it's clear exactly what it is versus what they might expect. A U.S. equity is very clear on what it is because it's been around a long time. So people generally understand pretty clearly what they're getting when they buy it. If you're going to have some sort of derivative, it's different. And so you have to make that really clear. The second point I make, and maybe this is a fourth model, because the way we've proposed it in the NASDAQ filing is that the token form is simply a representation of that same share, just done with a different technological approach. So I always think of it as, today, the way everything is, it's digital, it's in a database, and it's, you've got an account at DTCC as a clearing broker. They have a sub account representing their clients, and so on and so forth, all the way back down to the individual. And then the future, and again, think of this, the way we think of it is a first step. In this, in our proposal, it would be just, instead of representing it in a database, it's represented using a token that's created on a blockchain, and you can almost replace the idea of the account with a wallet infrastructure. And so why did we want to do it that way? I think it was really the heart of your question, Andrew, is where we were coming from, is we wanted to make sure to start that it wasn't a big change for the investor, where they're going to have a representation of the same exact share as what they would have today. And the view there is that over time, that is going to enable some of the cool ideas and ways we can improve the markets that, you know, many of my fellow panelists have raised so far.
Yeah, maybe just to put a finer point on it from my perspective, I mean, item 202 of Reg SK clearly requires the rights associated with any security that's being registered to be fully disclosed. So I think the existing disclosure regime is sufficient on that front. And then, you know, obviously any issuer or intermediary that's marketing it is, you know, marketing it in a very clear, consistent terminology and explanation is going to be important to any regulated entity, and something that the industry can obviously ensure happens.
I'll just give a little bit. I agree completely with both Chuck and Coy. I think disclosure rules are pretty good today. I think if I use the GLXY example, we didn't issue a new share class. In fact, we didn't issue any new shares. There was no issuance, right? What we've done is allow existing shareholders to move their shares out of a brokerage account, which of course you can always do, and use the DRS system to move their share ownership out of the DTCC and put it directly on our books and records with our transfer agent. It's not something you would do very often. It happens in strange capital markets transactions like pipes, or if you acquire a company and you pay the acquired employees with your stock and you don't know their brokerage account, so you just put the stock on your own books and records and wait for them to show up. It's not used very often, TA directly ledgered shares. And then our transfer agent has made it possible to say, hey, do you want these as tokens? And you can. There's 33,000 of Galaxy's shares that are tokenized on Solana today. But because it's not a new issuance, and it's not a different share class, it's the same disclosures as with all of our other issued shares, right? And of course, we made some unique sort of representations or disclosures about it. And I forget which of our in some filings we explained we might do it. We highlighted various risks that might impact an investor if they chose to hold their tokens, their shares as tokens on Solana. So there are some unique, I think, newer disclosures generally about the technology that are useful for investors to know. And then there's some interesting, we broadcast on our website. This is our contract address on Solana. Any token that claims to be our equity that isn't emanating from that contract is not our equity, right? So there are some interesting, I think, new characteristics of the technology that may warrant additional content to go in the disclosures. But I agree that I think the existing, disclosure frameworks and rules are basically sufficient. And it's more of a matter of educating shareholders about what they're using and what this new format might mean if there are changes. And not all, by the way, we envision that our tokenized shares on Solana, say if like a broker dealer were to be allowed to hold tokenized securities, a shareholder might eventually send the tokens to a custodian or a broker dealer, in which case.
Oh, Alex?
Yeah.
Yeah, I'd just like to intervene and try and sort of simplify the question, take a step back and ask the panel for a sort of very basic fundamental question when it comes to the issuance of tokenized equities. The way I understand things today, like we are in if it's a 365-day year, we're in day 4, day 3 maybe of this, right? Like there's a few tokenized equity options out there, but it's really not widespread. That's not where the vast majority of the liquidity is. But I've heard from a number of the panelists, a lot of major potential benefits associated with issuance of tokenized equities. And I guess my question is, in the view of the panel, are we looking at a future 5 years from now, 10 years from now, where in your view, the benefits are so substantial that they've resulted in the vast majority of equities now being tokenized, now being traded in with blockchains? And so that's a basic question. But another basic question is, does the SEC have to make important policy changes in order to allow for that future if you think that's where we're going? So that's a question for the panel in general.
Yeah, John, if I can jump in. So, by the way, I think what Galaxy are doing is the end state. It's exactly what we want to see is digitally native issued securities on chain. We do need the SEC to do certain things. We need to have an environment to trade those in DeFi on a decentralized exchange and know what the rules of the road for that are. We do need clarity on which models will have same security status. The end result is all you should know is whether or not your share is tokenized. Unless it's a derivative, you don't have all the same rights as the regular way security, there shouldn't be additional disclosures. You should just know whether or not you're in a tokenized state. And so having clarity from the SEC, which models will meet that is very important, and how you can trade those or how you can use those outside of a broker-dealer environment is critically important. And in terms of getting there, like this time frame, like it's an empirical question and time will tell. But what Galaxy is doing is where we ultimately want to get. It's unlikely NVIDIA and Apple and other companies are going to do this in the next 6 months. But what can happen in the next 6 months is with an approved model, is have the wrapping of those securities in such a way that all the rights and benefits are conferred to the holder of that token to jumpstart and get all of the, for example, S&P 500 companies on chain in that model. And ultimately, we will graduate, hopefully, to where Galaxy is. And the time frame will be determined on how useful investors think that is.
So that makes some sense to me, right? Like it's hard for me to imagine this being an issuer-driven process by the largest companies in the world pushing to have their equities, tokenized in the next 6 months to a year. But if this can be a broker-driven process, which I understand perhaps it can be, then you could imagine a transition happening more quickly.
I think maybe just to add some nuanced thoughts there. I mean, I think it's kind of driven by a variety of market participants, right? It's who are going to be the first movers of the issuers, the brokers, the corporate action providers. It's a little bit of it requires a little bit of everybody to really realize that the technology is going to bring incredible cost reduction and efficiencies, and make the decision to really push forward. Because I think, in all fairness to the SEC, they're doing a great job of facilitating requests they're coming in, but industry needs to come to the SEC and say, these are the specific rules that are standing in our way right now, and this is why we want relief, or this is why we need a rule change, right? I think I used the term chicken and an egg problem before, and I think, as that plays out, I think the market will take care of that. The proper role of the SEC over the next set of years is to allow for the different experimentation, to allow it in a transparent way that everybody is playing on an equal playing field, and the like. So I think we'll get there. It's just the timeline is impossible to predict.
Well, from my perspective, I think Andrew's question was kind of getting at this. Like the biggest risk here is that in a potential transition towards tokenized equities, you have investors who think they own something, but they don't actually own it, right? Like it's a wrapper, but they don't actually own the security itself. They own an obligation of the issuer of that wrapper. And unfortunately, the issuer of that wrapper is now going broke. So they don't actually own the security that they thought they owned. Is that a realistic problem? Does that require regulation to protect against?
So I think the existing disclosure rules would cover that situation for sure. I'm not sure I have anything to add other than the earlier part of the conversation on that.
Yeah, I think to deem it the same security, you have to be able to demonstrate what Coy just said. Like if you can't do that, then that's where the issues will be.
I guess I would just add to that. I think that this is an important challenge that needs to be addressed by industry, because technology creates many, many more pathways for investors to participate in markets, period. And we are already seeing, very rapid product proliferation in the investment landscape. that while we have plenty of existing disclosure, investors can be overwhelmed with information, and it can be hard to aggregate it in a useful way in order to make informed investment decisions. And the fact is, while I could go to many websites to read exactly what, particularly if I look at the European sort of derivative example, what those are, when they were launched, a lot of the social media and marketing around them made it sound like they were, tokenized equities as opposed to a derivative contract with some counterparty exposure. And I think that's a function of the environment that we're in right now, which is, I think, in many ways provides like profound opportunity for investors, because there is the ability to customize more, access more, create broader and more diversified portfolios. But if we as a kind of U.S. markets ecosystem want to maintain trust and investor confidence, we have to work together to kind of promulgate certain standards around language and classifications and guardrails. I think that Alex makes a really thoughtful point around the fact that in some cases this technology will enable new practices that, however, if we all use the technology in different ways to create new practices, it creates this potential like Tower of Babel effect, which is more overwhelming and confusing for investors. So I'm not sure that it is a solvable problem by regulation, but I do think we have many examples of successful industry-led practices and guardrails that work pretty well. And I'll just add, one more thought here around what Scott said around the crypto crash of the weekend of October 10th. I'm not sure that was a shining moment of transparency in the industry. I don't think that in the traditional securities markets, I think for some, as much as the technology lent itself in a helpful way to a post-event forensic analysis, I think there are a lot of guardrails that exist in traditional markets around margin rules and leverage limits and how external, pricing sources are used versus internal order book sources in order to determine margin requirements. And so I think it is really upon industry, if we together agree that the opportunity set is there, like how do we align around some best practices to deliver on it without surprising people in a way that they end up not wanting to engage.
Okay, can I also just add to Samara's point about October 10th, which I agree, it was not a shining moment, broadly speaking, but I will highlight that was primarily involved centralized crypto exchanges. It was not primarily an event occurring in the DeFi environment. So I just want to point that out. What happened to the extent, the impacts of any market activity or that market crash were highly transparent in real time when it comes to on-chain finance. Most of the issues that have been identified as accelerating that related to centralized crypto exchanges.
Interesting.
And so to round out kind of our discussion here, something for us to all think about is, so, we talked about, is disclosure sufficient, which is one question, but then on the other hand, something to ask is a disclosure simple? And I think this is a recurring theme that we see time and time again, where we understand that, frankly, just because something is disclosed, sure, it's buried in, hundreds of pages of documents, but for, at least as we see it right now, when we buy traditional shares of traditional equities, right, it's pretty clear, generally speaking, right, what the ownership is. And so just to try to, I think, delineate between, right, again, fulfilling disclosure obligations versus investors actually understanding what it is that they own and what their rights are. I want to turn it over to one of our committee members, Andrea, who I believe also has a question.
Yeah, thank you, Andrew, and thank you to the panelists for the discussion. I have a question about investor rights and remedies. I originally was thinking of this question when Coy was presenting and talking about, you know, derivatives being sold in the EU that are essentially the equivalent of US stocks that couldn't be purchased otherwise. And so one of the questions or the concerns that I have, and we face this at the state level, is just jurisdictional. You know, when investors overseas are purchasing these, you know, those investments and they don't have that nexus to the US, they may be purchasing from an intermediary that's not regulated by the US. You know, what happens when there is investment fraud or manipulation over here? I mean, one of the reasons we have, you know, national regulation is to create that nexus, to create that jurisdiction. So when there is misconduct, there are rights and remedies and jurisdiction for those aggrieved to take action, or for the regulators to take action. And so, you know, obviously, over in the EU, if there's an issue, are they going to be able to have the same rights and remedies that an American investor would have if they purchased that from Robinhood on the state side? You know, are there jurisdictional issues that still need to be resolved because of the global marketplace? And Coy, you don't have to take that. Any of you can take that, but I'm just curious if that's something that has been addressed in your white papers or has been addressed that we could take a look at.
Sure. No, I'm happy to briefly address. I mean, I think from a European investor standpoint, you know, that product is completely licensed under MiFID and in accordance with the local rules and regulations, right? So investors there have every right that they are entitled to under the EU's MiFID regime, which is quite robust and the like. I mean, obviously each, you know, I can't speak for all products that are out there of their local jurisdictions and the like, but the EU regulatory regime is certainly very robust on investor protections.
Anyone else have comments? Thank you, Andrew. Thank you, Coy.
Okay, well, in the interest of time, we will then move our discussion now into the portion on trading, which we'll spend most of our remaining time. And so I want to first, you know, been thinking about some of these other ways that transactions can occur using this technology. You know, a number of you had mentioned the opportunity for peer-to-peer trading. But at the same time, I heard from Scott just moments ago, you used the term, you know, what is genuine DeFi, which then, you know, kind of leads me to wonder how, you know, so how do we actually know, right? Because I think this was raised by a number of you earlier too. How do investors also know that the venues or the ways that they trade are truly decentralized, right? I mean, where something is dictated by code or something, and not, you know, there's no, let's say, manual sort of intervention there, right? There's no discretion or other, you know, activity like that where that would probably resemble something more of what we see in different traditional contexts. So I just wanted to put that, like, how do we know something is truly decentralized if you say that?
It's a great question. I'll just briefly, with our model, you still have to perform KYC and onboard with our transfer agent. So we know every token holder's identity, although of course, you know, the addresses themselves are pseudonymous. A consequence of that, right? And then the tokens cannot freely, they're not bearer certificates. They can only be transferred between onboarded individuals the way we've designed ours. But as an interesting consequence of that design, Andrew, is that most types of decentralized exchanges, such as an automated market making pool, it has its own address. So unless we, through our transfer agent, whitelist the pool's address, the tokens won't be able to flow into that DEX either. So we consequently have control over which venues on chain our tokenized stock could trade. And so some of that burden of you know, whether it's assessing the safety of the protocol, the maturity, its level of decentralization, any other characteristic of it, consequently is falling on our transfer agent and therefore us, right, as they are our agent. So I think there's a lot of ways to answer your question about like what features would be the important features and would pass that threshold. And what is decentralized enough, for example? So without bogging the conversation down with that, I would just say like that you could imagine either principles or even possibly explicit guidance emanating from the SEC to guide an issuer like Galaxy or our transfer agent as to how to assess them, or there could be a diligence threshold placed on the issuer or the transfer agent or whomever the controlling, the party that has the capability of allowing or not allowing the trading into that venue. Could be a diligence threshold that we may have to meet, or something like that. It's not quite clear. There's a lot of variety in what an on-chain application looks like. Of course, by being deployed on a blockchain does not mean that it's automatically decentralized, right? And so I think it's a very good question. I think, we hope to pave the way here for what some of those principles might look like. We've written a very long white paper about this as well that includes what we consider credibly neutral, sufficiently decentralized, things like that. But it's a very good question, I would say. And it so happens in our design, we kind of have because we have the power to allow list and address, we consequently also have the power to control where it trades. And so, we probably or our transfer agent will have to make that some level of that decision relies, on us.
Yeah, if I can just add, this is where the SEC is going to play an important role in deciding what are the administrative hooks into a DeFi protocol from a centralized entity, whether it's an issuer or a platform trying to make access to this. That's going to entail making some decisions on what are the principal characteristics of decentralization or decentralized protocol, such that if those administrative hooks were placed in that protocol, it would be deemed sufficiently decentralized to demonstrate all the properties that we have said here meet the requirements for investor protections as laid out in regulation today. And so that's where the role of the SEC is. Does that, if you think about Uniswap v4 protocol, it's something that we can say is decentralized, there's fair access, fair and transparent fees, there's decentralized governance, there's non-discretionary operation, go through a whole host of characteristics. And lots of people have described what they are. You know what it looks like when you see it. And then being able to say that is deemed decentralized, it's not so-called DeFi, then that is what we are talking about in terms of being able to enable Galaxy to trade or some other tokenized asset in that environment.
Andrew, perhaps it makes sense to try to take a crack at simplifying the discussion around DeFi a little bit. So I think, because it's complicated, there's a lot of jargon. There's a threshold question as to whether any firm is involved that meets the definition in the 1934 Act of an exchange, broker, or dealer, right? That's a threshold question. And, it's not our role to make that determination for other market participants. That's a question for, other market participants and the commission, right? But it's an important question. I would just note that to the extent the answer is no, then exemptive relief from those statutory definitions, should not be required, right? You don't meet the definition. You're done. Now, to the extent that firms are involved in DeFi protocols that meet those definitions, then there's a question of whether exemptive relief should be granted as a policy matter. And we've heard arguments as to, some of the rules associated with those registration categories don't make sense in the DeFi space, or the policy objectives may otherwise be satisfied by the protocol itself or the blockchain, what have you, right? And so, first of all, I'm skeptical that's the case as it applies to the full suite of investor protections that would drop away to the extent that blanket exemptive relief was granted by the commission, right? Like, who would be providing best execution? How would the trading venue be enforcing trading halts that are market-wide, right? Things like that. But importantly, I think it does raise the point that we should be doing that rule-by-rule analysis to the extent that there are firms involved in DeFi protocols that meet those intermediary definitions. We should do the rule-by-rule analysis. We should identify the rules that don't make sense, and we should change them, right? But the suggestion that we should just grant blanket exemptive relief and not do that rule-by-rule analysis strikes us as an approach that is very dangerous, because the U.S. equity market is of such fundamental importance. We should take the time to get this right. We should do the work and go rule by rule and identify the ones that are impediments and change them.
I mean,
Just
Jonah
maybe
makes.
follow up. Sorry, go
Go
ahead.
ahead. No, I think Jonah makes some really good points, and I think to think about tokenized securities, trade in a decentralized environment, that does not require a broker. So as Jonah said, there's no relief required if a broker is going to be trading in that environment. But you need to get those assets into that environment somehow. And so there will be administrative hooks that go into it. And the question is, in order to facilitate that, who would be doing that and what exemptive relief would be required? To me, it's best, given this environment, that the SEC weighs in, looks at this, assesses what those risks are, makes those determinations, and then we can, in parallel, go through and say, what would it mean for a registered broker-dealer to participate in a DeFi pool? Ultimately, we're going to have two classes of securities, those that are tokenized and those that are not. And there needs to be economic arbitrage, not regulatory arbitrage, across those two pools. The best entities to do that are those that are already registered with the SEC. So I agree that we do need to have that analysis rule by rule. And by the way, the rule by rule analysis could be on Reg NMS generally and not necessarily related to DEXs. But ultimately, I think we do want to see broker-dealers operating in those decentralized pools, but you can't put regulatory obligations on a DEX the same that exists on a broker, because if you do, you'd be asking them to take control of assets or the protocol and then introduce all the risks that don't currently exist in that environment. And so I agree that we need to go through all that very carefully, and I hope that's what the SEC is doing. I think that's what the SEC is doing based on conversations we've had and others had. But I think we're fully aligned on the principles here. I think it's in practice implementation that we need to make some more progress on.
Yeah, I also want to agree with Jonah on the point that he made, which is that if there are persons, yeah, I think you said firms, but right, if people control the DeFi protocol, then perhaps it isn't decentralized and thus might be a normal national securities exchange or a broker or some other entity that needs to register. We agree with that. I think our point, our view is that there, both as a policy matter and as a regulatory matter, there's great benefit to transacting in an autonomous marketplace where there is no person or group that can be seen as controlling the code. That actually reduces risk in many ways. It's different, no doubt. There may be other new risks, but I think we're very focused on finding out if securities can trade and what the implications of their trading is in the case that they do trade in a marketplace that is so decentralized that it couldn't pragmatically register. And I think your point, Jonah, about if it then can't register and wouldn't be an exchange or a broker, then what relief might be needed, if any, I think is a great question, right? We have believed and wrote in our paper that in such a situation, we don't think any relief would be required. I think, we also live in the world where we want to interact, helpfully with the SEC. I don't know that that's the SEC's view, right? So I personally, if there's no entity to go in and come and register, then I don't see how they should have to register. And your point may be that they shouldn't need an exemption. We agree with, broadly speaking. One last point I would make in reaction to Jonah's comments is that I think it's a bit of a straw man that he's talking about broad exemptive relief. I don't know anyone, none of the panelists here in our opening statements called for a broad blanket exemption the way you're talking about it. In fact, I explicitly said we would seek a limited exemption, right, for the purpose of understanding how these things would work. I haven't heard the commissioners talk about broad blanket exemption. So I just want to point out, I do personally believe that's a bit of a straw man argument you're advancing.
Well, if I could just respond quickly, I mean, I think we do see in the Crypto Task Force comment file, for example, several requests for exemptions from the definition of an exchange or a broker or a dealer, right? And so I would classify those requests as broad, given that once you exempt a firm from registration as I explained in my opening remarks, all of the substantive investor protection requirements that we are all used to when trading US equities immediately fall away as a consequence, right? Because they are only applicable to the extent that a registered intermediary, whether it be an exchange, a broker, or a dealer, is involved. And so when you're talking about the consequences of granting exemptive relief from those registration categories, you necessarily need to consider all of the knock-on implications for investors when suddenly the full suite of investor protections is gone.
One other follow-up I had to this is just thinking through, we're talking about technology that is evolving very quickly. And so when we talk about this, especially in the context of DeFi, Alex, you mentioned automated market makers, for example, right? This is these are market makers that are using a formula in order to be able to make markets, right? Using different liquidity providers to do so. My question, though, is, in a fast-changing world, if let's say a traditional market maker, automated market maker decides that their formula is too rigid, and they decide that they want to, this is not profitable for them, they want to change how that operates. How does this work in our securities law framework? Given the fact
let me
that
clarify, Andrew.
we're transitioning away from one entity to another potentially.
Yeah, let me just clarify. The AMM is not like an entity that runs an algorithm. It allows any person to be a market maker, to provide, make, or take liquidity from a pool of assets based on predefined rules, right? Like one of the most iconic is Uniswap, pioneered this model on chain. This is a set of code that dictates, like, if I put $1 and an equivalent amount of another asset side by side, now other parties can come and do the same or take at any time. It's not an entity that's operating an algorithm. It's software that allows theoretically anyone to passively make or take liquidity from a pool of assets, right? So that I would say that the AMM suggestion is that code is permanent. It's the reason why, for example, Uniswap has many versions out there, because every time they want to add a new feature, they just simply have to redeploy it. They can't come and take down the original code. You can go and use old version of Uniswap if you want, right? That code is available and unchanging, I should point out. It's a little different than, there are many other constructions, but when I refer to the AMM, like that is sort of the iconic decentralized code-based unchanging pool DeFi sort of exchange, right?
Okay, interesting. Okay, so I guess, my perspective with respect to trading is that the existing US equity market structure works incredibly well. I mean, we have the lowest costs that we've ever had. We have lower costs than anywhere else in the world. That doesn't mean that there can't be innovation like tokenization that can make it better, and that we shouldn't, try and make sure that we provide an appropriate regulatory environment to allow for that possibility. But one worry that I have, and that I'd like to better understand from you all, is, let's say that there is this transition period where some equities are tokenized, other equities are not tokenized. Does that not mean that there will be less liquidity in, the non-tokenized equity markets for a period of time as this transition occurs? Will that mean higher costs for investors? What does this transition period actually look like for investors, for liquidity and for costs? So that's sort of a basic question that I'd like to open up to the group.
Hey, John, maybe I can start on that, because I think you hit on a concern we talk about in our filing and a couple other places, which is, we think of it as like fragmentation of liquidity or really the asset. You're kind of fragmenting the asset the way you described it. And I think what is a key thing to think about there is fungibility and interoperability, and ensuring that exists. And one of the reasons we took the approach we did in our filing is because we didn't want that. We didn't even want to allow for that, frankly, at this state. I mentioned a couple times that the way we think about it is it's like a first step in a multi-step evolution. We want to enable the usage of this technology, but we do not want to have like a completely different form of this asset where it can't be in the same liquidity pool if people want it. And so the idea is at this stage, understanding that it could evolve, but at this stage, you're trading in our order book the same way you would currently, but you're just choosing to have it tokenized. And the reason I think people might ask, well, what does it actually do? And what our response is, it sets the stage for things that are much more interesting that Alex has been talking about and others have been talking about here in the future, but it does so in an iterative way. And I do think it behooves us all to think through your question and think about how we are going to evolve the market and have the infrastructure and the pieces of the puzzle work together such that we do not have an end result of what you're talking about. Because you're talking about serve two, and there doesn't necessarily have to be two. There could be many, which would be worse than two. Versus right now, you've got the core asset, and you do have derivatives on that asset. I mean, you have listed derivatives too. You have listed U.S. equity options, which is a very big market on its own. And as others have mentioned, there's these derivative products in Europe, but the core asset really drives everything. And it's the level of liquidity there is matched nowhere on the planet. And so we want to be very thoughtful about that. And I want to be careful here because I don't want to give the impression that I don't want to see evolution. I don't want to see innovation because we do. We want to embrace that. We just want to be thoughtful and careful as we move it forward. And sure, we end up in a place that while sort of the world might shuffle around a little bit, the end result is the end investors got something really great, at least as great as now, if not better. And same for the issuer. And so in that path, in that journey, we have to be very thoughtful about that question you raised.
Can I add to that? Actually, I think that's so well said, Chuck and John. I also think it's such a critical question because I guess my own hypothesis is that for the reasons you said earlier on, we might actually live and operate in that transitional period for a longer period of time with respect to U.S. than kind of the 5 years, which was the question that you put out there. So how do we ensure market integrity during that period of time? I think what I hear, Chuck putting forward is a phase one, which is a pretty tightly prescribed model in which we cannot have that decoupling, but we can get some experience as a market and build on from there. I think, Alex, you described a market, I think, and correct me if I'm wrong, I'd love to get your thoughts on this, where you do potentially have these two things in a transitional period that could trade at different prices. And then, Scott made the point that, and I think this term around, productive or economic arbitrage and interoperability, which you said, Chuck, like that's the core here. I think what solves for the price alignment, fragmentation, or lack thereof, and is the degree of interoperability and enabled arbitrage. And I think, again, we have experience in a market. We know there's generally three conditions to arbitrage happening. They are, number one, there are market participants who can access both things. Number two, they can determine valuation. There is valuation clarity around where they will trade both things. So access, valuation clarity, and then certain of execution. And if those conditions are in place, people have the economic incentive to do those trades that will maintain price alignment. So I guess my question for you, Scott, is for you, Alex, is in that world where you do have misalignment, how does the arbitrage happen? Like, is that how you view it? And how would you see that arbitrage happening to close the quote unquote dislocation?
Yeah, it's a great question, Samara, and John, it is great. This is when we were designing our project here, and this is a core question that we have and how to solve for that. And I agree wholeheartedly with Scott's point that it's economic. The arbitrage has to be able to occur, Samara, right? And it's just trading in different venues. You can trade stocks across different venues. You could trade a stock on the NASDAQ, and we love that our
We lost Alex. Maybe while we wait for him to come back, can I just by the way, Samara, I love your I love your point. I agree with it. And I just wanted to inject one more piece of information here, which is the difference between the two models that we're looking at today is also a difference in technology, limit order book versus a curve pool. These are different things. And I think understanding the resiliency of a curve pool over time with high volume tokenized securities trading is a really interesting innovation. And to your point, letting economic arbitrage work, we need to have entities that span both of those markets. This goes back to Jonah's point. If you have a regulated entity in a regulated market, what are their obligations if they're in this DeFi environment? We need to figure that out. But I would point out, and this is a submission we made to the SEC during the Bitcoin ETF or ETH ETF ETP approval. If you look at Bitcoin and ETH trading, not subject to Reg NMS, the adjusted bid-ask spreads of those two assets are narrower than every other stock in the S&P 500 except for NVIDIA and Apple. So already without the regulatory infrastructure that exists for tokenized securities, in the crypto market today with high velocity assets, there's really tight economic arbitrage. So once you hit escape velocity or the tokenized version in DeFi, I don't think those price disparities in high velocity assets like we're talking about here, Reg NMS stocks, is going to persist.
I'm so sorry too. It looks like I dropped. You guys can hear me now though? I'm back.
Yeah, you're back.
I was trying to do an Alex impersonation.
No, I appreciate it. I'm sorry about that. I'll be fast. I'll say that, for us, right now, the way that you think of it, like I'm using crypto terminology, the bridge, the way to move your shares, to format them traditionally, if they're tokenized, like bring them back into the traditional system or take the traditional shares and tokenize them, occurs through our transfer agents. And so we've taken a lot of steps to smooth that process, to, liquidate that pipe so that, sophisticated investors could participate in that economic arbitrage. There are some questions that, for example, the Citadels is a great example. Like we would love them to be trading our stock on the NASDAQ and the tokenized form to help keep those, to close any arbitrages that emerge, right? And so sort of as designing it's very important for us that it's easy to move between venues, whether DeFi or traditional, and then investors can close any arbs that exist. That there are some regulatory questions.
Oh no.
Uh-oh.
Thank you.
I'll get Alex back here. I just wanted to then maybe follow up. We talk about, so hearing panelists talk about the, I've heard a number of you mention rule by rule. The SEC should look at things rule by rule. But what about, are there any impediments that we're looking at, either from technology? I mean, right now, as I kind of look, we have, there are multiple different chains that operate a little bit differently, and we're talking about multiple different venues. Are there any, we heard about bridges, right, and potential other protocols that may exist, but is there, so what either technological or other impediments currently exist where, for let's say, if Reg NMS, where Reg NMS, applies and the entities are, more or less the same, the technology is different. What does that actually look like in terms of, what are the impediments that exist for, let's say, best execution or all trades to be reported over the consolidated tape? Anything on technology or anything else that folks see or could use more clarity on?
I mean, maybe just to highlight, from the blockchain side, the technology is pretty, I mean, again, we've all talked about the benefits of programmability, right? I mean, there are different token standards, for example, that can be interoperable amongst different networks and the like. So I don't think the technology from the blockchain side will be the difficult hurdle. I think that can be engineered in a way to marry well. It's really that point of intersection between the existing infrastructure and the blockchain technology and everybody's ability to engineer and talk to one another about that. I don't know that we're at the point as an industry that a specific rule change would be needed for that. I think, again, I got to keep coming back to the same point. I think it's market participants that are putting this together as they are engineering it and building it need to raise to the level of the SEC and other regulators that, hey, this is now a problem. We can't do this. But I'm not sure that we're at that point.
I don't know if I would call it, so this isn't a regular point, but I think if Andrew's question is about impediments, I would go back to this discussion we were having around the enablement of arbitrage and things that will get in the way or create speed bumps or blockages to that arbitrage happening. That's what we have to That's what we have to assess. And so, for example, despite the fact that blockchains are transparent and therefore, there is price transparency, there is still an exercise around price aggregation that would be a prerequisite of determining valuation clarity, such that a market participant knows and gets the signal that there is an arbitrage opportunity on which to execute. So I think assessing the potential frictions to that arbitrage ability, again, with respect to access and registration requirements, are there sufficient liquidity providers who can participate in both ecosystems such that they can affect the arbitrage transaction? I think listing out with the principle of, frictions and affecting arbitrage is how I think about that impediment question, Andrew.
It's a really great point, and it brings me back to something Scott said earlier. You want economic arbitrage, you do not want regulatory arbitrage, which I think is a really good point, and we would definitely agree with that. I think when it comes to arbitrage, though, somebody mentioned, that's sophisticated players do that and keep prices in line, which I agree, that's the case. The one thing we should be cautious about is having sort of multiple versions of something, because I think it's easy to forget that investor confusion can be very problematic, even if it doesn't cause like some sort of blow up or something like that. It can deter confidence, trust, and frankly, participation in the market. And I don't think, nobody wants that. We've got this tremendous market with a really high level of individual retail investor participation, and we want to keep that. So it's not something I'm sort of disagreeing with the path. It's much more about, let's just ensure we're thoughtful about that, and if that is going to be a problem, think through how do we solve that. The other point I wanted to make was kind of around some of the discussion with regards to sort of I would call it definitions. I think it is there's a lot of things. It's almost like we've raised more questions than we've answered here, because there's a lot of clarity we need, and it is going to require collaboration amongst the industry. It is going to require working with the SEC. It's going to require a lot of work on the SEC's behalf as well, where they're going to have to look at these rules and see where different things fit in. And in my mind, where something doesn't fit in, I think that's a great place where some sort of question to the market can be put out, where it's like, hey, we need help on this particular thing. And this is coming from the SEC, and then all of us and others can chime in a very transparent debate about it, and hopefully get to a better place. The public comment and process, public comment and notice process can be a bit slow and frustrating. I think, Alex, you mentioned a years-long process, which you would like to avoid, and I totally get that. Trust me, I've gone through lots of rule filings, but at the same time, there is some value in it when done right, and as long as it does not go on in perpetuity. So I think we should take advantage of that. The SEC should take advantage of that to ensure we have a robust framework and process to move these things forward in a really thoughtful way, and ensure that we're, enhancing markets and not creating inhibitions. And Samara used the word friction a couple times. Definitely want to make sure we're reducing friction, not increasing friction, specifically for issuers and investors. Sophisticated players can always deal with that and have arbitrage opportunities, but the frictions for individual investors and issuers are things that are definitely not good for a market, because those are the two key endpoints of this capital market.
So yeah, those are all really important points. And Andrew, with respect to your point around moving away from blanket exemptions that would serve to disapply the full suite of investor protections in favor of a more nuanced, targeted, rule-by-rule analysis. I think looking at Reg ATS is an important reference point, right? Over 2 decades ago, a number of venues came to the commission with concerns similar to some of those being raised now, arguing that the full suite of exchange regulation, hindered innovation. And the commission responded not by granting a full exemption from the exchange definition, but by coming up with a lighter touch regime that was appropriate for those venues, right? While still maintaining critically important investor protections, such as best execution. If a stock is halted on, an exchange, it will be halted on the ATS. There's a consolidated system of market surveillance, right? The ATSs are part of the national market system. They're not completely outside of it and completely exempt. And so that, I think, is a very instructive example as to the appropriate process to follow here. And as Chuck mentioned, process is critically important.
Yeah, Joni, you mentioned best execution. I actually had one final question about best execution in the context of DeFi, because I thought it was a good back and forth discussion earlier about we're talking about broad exemptive relief, we're talking about specific exemptive relief, and it sounded like everyone kind of agreed it should be specific. But what about best execution? I mean, to me, that's like the fundamental rule at the heart of our equity market structure. And it's hard for me to conceptualize the DeFi trading of tokenized equities without best execution, right? Because how else can the owner of that equity, the buyer or seller of an equity, know they got the best price for it or got a good deal for it, that some obligations applied? So I guess my question is more for Scott and Alex. What are your thoughts on whether there should be a best execution standard, for DeFi trading of tokenized equities?
Well, I can start. I mean, I don't think you can have a DEX report to the SIP or do trade confirms interoperate with the MBBO because it's just code. I suppose you could write into code, but I don't think that's the value of the DEX. Everything is public, is transparent, APIs, and aggregators can use that information appropriately. But I think where the challenge is going to come is what happens if Citadel wants to trade in both markets? What is their obligation for best X if they're doing something on chain versus off chain? And I think going through the whole list of NMS rules that start with the number 6 and trying to figure out how each one of those would need to be addressed in that particular circumstance. I think that's going to be the trickier aspect here. As I said before, we want the market makers in both markets to do that arbitrage. As Alex said, there needs to be a way to move those shares back and forth through a transfer agent or some other function, depending on the model, so that you can actually perform the arbitrage the way you would do an authorized participant would do an ETF. You need to have that as well. That's what Samara's point was. But I think the trickier point is not going to be the DEX because they just can't comply. It's going to be with a regulated entity, a registered entity that wants to be in both markets.
Yeah, and I'm hesitant to speak because the last 2 times my internet appears to cut out right when I start. So let's knock on wood here. Oh, it almost did. I would say, look, best X today applies to broker dealers, market makers, ATSs, right? That we're in the construction that we are creating and that we envision in a truly decentralized, autonomous code-based peer-to-peer trade. Like there is no broker dealer but you are going to get the transparency about knowing exactly when you trade in an AMM, you can see exactly and calculate exactly the slippage that will occur. Like, exactly the form, right? But it's like, it's much more akin to an OTC peer-to-peer trade than trading, through having an intermediary select the venue and getting you a price, right? In my sense, and that's one reason why, by the way, I don't necessarily at all envision that all equity trading in a tokenized format is going to occur in such a venue. Okay. In fact, today, if you look at the ratio, say take of Ether, right? ETH, the cryptocurrency, the ratio of trades that occur in a DEX versus a centralized exchange is only about 18%. Still large centralized crypto exchanges are the most liquid place to trade ETH against a stable coin or against USD. So it's not even so much that I view the DeFi trading venues overtaking something like NASDAQ at all. It's merely another interesting option that some investors may choose in sometimes, right? And so, I don't see how an autonomous, code that's facilitating a peer-to-peer trade could provide any kind of BestX or NBBO, compliance. But I also don't see that it should, right? Those are really for centralized entities that are handling a customer order. And the future I'm thinking of, maybe not the only one, but when we talk about tokenized equities trading peer-to-peer through DeFi, I don't see how BestX is actually relevant.
Yeah, I guess my worry is just that a retail buyer through a DEX transaction would just get a bad deal. They would, overpay for tokenized equity, or sell it for less than it's worth, and I feel like BestX protects you in the existing market structure, but wouldn't apply there. But okay, I understand. Thank you. Andrew, do you want to go to settlement for the 10-12 minutes we have left?
Yep. And so I wanted to ask a question related to settlement. So given one of the big value adds of using the blockchain is that there is the availability of atomic settlement, right? So effectively instant, shorter than even T+0 type of settlement. But the question is, and this point was raised during the roundtable as well too. The technology is there to do T+0 settlement, but what considerations need to be thought about before even getting there? Because some of the points that have been raised too is that with T+1, which the SEC had moved to in 2024, that time period still allows for netting, of which we see about 98% of trades that can get net and offset with one another. So if we then suddenly migrate to T+0, what the question will be is, what are the factors that need to be considered before making such a significant change, right? Because that potentially affects how securities lending works. That affects how borrowing shares for short selling would work. How do you all think, what are the questions that you would like to see answered, or what would you like to see before T+0 settlement would actually be put into place?
Are you asking about TradFi practices? Because it's already in place in DeFi. It is atomistic if you're on a curl or a DEX, and that's kind of the benefits is you've de-risked because it's a DVP process, even peer-to-peer. And so if you're asking what it would be in TradFi, traditional finance, I assume traditional financial players like netting and settlement for a variety of reasons, other than just separate from the benefits of reducing capital requirements. If you didn't have that, so I guess I would if that's the right clarification of the question, it's probably more of a Jonah answer than anybody else on this panel. I don't know.
And to be clear, the reason why, we talked about, two different, market participants participating in both traditional equities and potentially also in tokenized equities, right? So if we're suddenly talking about different settlement time periods, right? So T+0 versus a T+1, that's an example of one of these potential issues, right? Market structure issues that arise from this. And so that's the question that I pose as to, so, the TradFi settlement process is a bit of a consideration, right? If we're talking about just the liquidity and fungibility of different stocks between these two venues. So I'll just kind of open it up again to others who might have thoughts on, what should be thought about in terms of, T+0 settlement and other issues around what happens if netting is not possible under settlement.
So one thing I'll add is I do think that very relevant here is the other conversation we were having around the transition, because it is possible if we envision a world where tokenized equities are onboarded, over a period of time, and there isn't a light switch effect, then we do have the implications of living in a atomic settlement and a T1 world at the same time. some of the mismatches that happen with respect to loss of netting and leverage in the system. So I guess just my high level answer to that, to your question as to what do you need to think about before, you need to think about how to manage that transition. You need to think about how can you create, and this is, how do you create like settlement and netting windows, for example, that live on top of these atomic rails? What is the best practice to effect, frankly, the provision of leverage in a more transparent way, using the capabilities, but allowing for the most effective risk management practices? So I think kind of that consideration of the transition and what sort of capabilities you want to build on top of atomic settlement is how I start to approach the problem.
That's helpful.
Yeah, and I guess I would just add, I think this is another area which would benefit from robust, public comment and market participant feedback. We recently went through the transition to T+1 in the equities market here in the U.S., and that was a process whereby we saw that there are many different segments of the market and different types of market participants with unique needs that need to be considered and addressed as part of any such transition. And moving to a world where Apple stock, again as an example, might have two versions with different settlement windows, just introduces another layer of complexity that has to be carefully thought through.
And I agree. I think this is part of the reason, though, that I think limited innovation exemption to let people figure this stuff out a little bit, rather than thinking that we as participants or the commission can sit in an ivory tower and dictate down rulemaking before we really know what it's going to look like. And I would also point out, Reg ATS, by the way, came about after years of back and forth, possible illegal operation, no action letters. It wasn't instantly handed down, and that's how ATSs were born. Similarly, the DTC, it took 10 years before 80% of certificates were held at the DTC. So there was a transition period there too. It doesn't mean there's not lots of thinking and work that needs to be done on rules, on processes, but I should point out, it's not unique that a new market infrastructure would emerge. And markets have dealt with that in the past as well.
Yeah, Alex, I think you made a couple of really good points there. And the one I just want to focus on for a minute is just this idea of transition and how long it takes. It does take time, especially if you try to be thoughtful and careful about it. And I think that's okay. I think a lot of the iterative evolution we've had in the markets has been really positive. One example, somebody mentioned it earlier. I don't remember if it was Jonah or Samara, but there's, we have limit up, limit down protections. We have market-wide circuit breakers. Those were done in response to things that happened in the market. They were not drastic departures from where the market worked before. They were iterative improvements on the market, and we don't even think about them very much today because they work pretty well. And by the way, limit up, limit down was adopted in one way and evolved a little bit along the way as well, with the people who are very close to that type of thing work together in a group and improves over time. So I think those types of iterative changes are really positive and can be powerful because they add up over time, and that's how we've gotten to such a great market that we have now. And Andrew, on your point on the settlement, I agree with what most folks have said here. I think there is the question around if you have two versions of the same security, one settles real time and one settles T+1 or in some sort of netting hourly by twice a day or whatever it might be netting cycle, you likely end up with two very different prices. And again, I don't want to underestimate what it creates when, from an investor confusion perspective, when something like that is seen in the market. A lot of times the assumption is going to be that is not fair, even if it is completely fine. And so we just have to be really thoughtful about that, and think about the benefits of the system we have now and versus the benefits of something that's more real time, and say, okay, how do we balance those things against each other? What ultimately would be better for the market? Okay, we decide this, whatever this is, and we kind of let that run and see how it goes, maybe in a limited way, maybe more broadly, but that's, I think, the right type of thinking we need to work through as an industry.
Chuck, if I'm allowed to ask a question, what would be the type of price differential that would result from a T0 settlement on a DEX versus a T+1 on an NSC? Like, I'm a little confused as to why price differentials would come in. It seems like they'd be de minimis or zero.
Yeah, it's a good question. I don't think I know the math behind it or know how significant the difference would be, Scott. It's a fair question, and somebody that is more familiar with it could probably answer that. But I think it raises a point of like, this is why we'd want that out in the public. But if I think about, just without having numbers, Scott, just thinking about the netting, right? If I'm a liquidity provider that is flat every day, I'm actually not usually paying to borrow shares. And so, but if I have to settle real time and I'm providing liquidity into the market, I have to borrow those shares immediately. And so I have to pay the financing on this. So now, how de minimis or significant that is, one, it probably varies a lot by stock and asset. Two, I just don't know what the actual math would be there and how significant that would be. I do know that any liquidity providers in the market, every cost to them goes into their price, right? So if there is a cost, it is going to affect their price.
So that would be the prime brokerage service overlay for financing that sits on top of the infrastructure. I agree that that's a service. So I think traditional finance likes netting and settlements, allows them to do things with their capital more efficiently. I tend to think that is a separate issue than the underlying infrastructure that it would sit on top of. I think those can be separated. But I think, if there is a friction that would result in a differential price, that is something that should be run to ground.
I need to interject. I want to thank everybody. John, Andrew, you have a minute to close. We have Commissioner Ueda, who's up next at 4 o'clock.
Sure. I don't have much to add, Brian. I think it was a great discussion. Pretty convinced there's a lot of benefit and opportunities here. Risks also, as always, and it seems very clear that the SEC is going to be playing a critical role in how the tokenization of equities moves forward, and the IAC will take all of this under consideration and do our best to be helpful. So thank you all very much. We benefited a great deal from your viewpoints and appreciate your time.
John, Andrew, thank you very much. That wraps up our afternoon session. Again, thank you for all of the panelists and moderators for the thoughtful discussion, valuable perspectives. It's now 4 o'clock, and we are going to hear remarks from Commissioner Ueda.
Well, thank you, Brian. You are right on time. Wow, you really know how to run a meeting. So thank you all very much, and thank you for the flexibility in allowing me to deliver my remarks at the end of the day. I was on travel from the West Coast, where I know Colleen's on the West Coast. I think James is also on there. You're on the West Coast, right? And so anyway, you would not have wanted to see me on after a red eye coming from the West Coast with a day of stubble and not showered this morning. So anyway, thank you for your flexibility. I apologize for missing some of your earlier discussions today on corporate governance and I just caught the very end of tokenization. I know after this, I think you'll be talking about artificial intelligence and your reputations of that. I know today well, there's Christina. I see now on my screen. I think today is your final committee meeting. Is that correct? Well, I just wanted to extend my deep appreciation to Christina for your dedication and your professionalism in this job. You are the second investor advocate in the commission's history. I had the privilege when I was counsel to Commissioner Pivar of helping select the first one, Rick Fleming, and then as commissioner helping to select you, Christina. So I feel very, very fortunate to have been in that roles and seen it develop, and now under two different folks. But when you first come in and we interview, I'm not quite sure what to expect and what will happen. But since then, Christina, you've won me over by finding areas of mutual agreement with me and then executing upon them. And I cannot emphasize what I believe is one of the most important contributions you've made as the investor advocate, and that is reforming the selection process for committee members. As I mentioned, as an SEC staff member, I was here at the very beginning. In fact, even before Rick was named as the first investor advocate, we had started up the committee before that. And it became very clear that following the statute, with the vast majority of the committee members leaving after 4 years, that was not conducive to long-term thinking. You would just lose so many folks, and it felt like that movie Groundhog Day, where you just have to start over again. And through Christina, through your efforts, we now have a plan where hopefully in any given year, about a quarter of the committee will be replaced. And that will thereby have a much smoother transition from year to year to year. And so we will have hopefully really an ongoing living committee that a little bit gets repopulated every year, but not this cliff scenario where we have to start all over again. So thank you, Christina, for everything you've done, for your outstanding service, and I wish you the best in your next steps. Well, your first topic, something that's on my mind, something in fact I was just talking about yesterday to the Institute for Corporate Counsel, but the role of corporate governance in the capital markets. And it plays such an important role in investor confidence and market integrity. It encompasses the systems, the processes, and principles by which companies are directed and controlled. At its core, effective governance ensures that companies are accountable to their shareholders and resilient in the face of evolving risks. Over time, the role of governance has expanded beyond traditional oversight. Companies are increasingly expected to navigate complex issues such as cybersecurity and emerging technologies. A well-functioning board must not only monitor management, but also anticipate and adapt to systemic shifts that could affect long-term value creation. Yet Congress specifically left the states in charge of governance under state corporate law. The federal securities laws and regulations play an important complementary role in providing disclosure, describing the governance structure, the rights of shareholders, and potential risks associated with a company's particular structure, not to mention our oversight of the proxy solicitation and voting system. However, as we consider reforms, we must be mindful of the temptation to use the Commission's disclosure authority for registration statements and proxy materials, as well as oversight of exchange listing requirements to impose prescriptive governance mandates. It is inappropriate to mistake the investor protection and public interest standards contained in the federal securities laws as congressional authority to set corporate governance standards nationwide. Congress does not hide elephants in mouse holes. Corporate governance is best left to the market to decide if a potential shareholder does not like a particular governance framework, such as maybe it relates to board composition, independence, expertise. Well, there's a simple solution. Do not invest. And then companies that have corporate governance structures that are not well received by investors will have a higher cost of capital and a depressed stock price. Similarly, another area of recent discussion has been the Commission's clarification regarding mandatory arbitration provisions in registration statements, and how the presence of such provisions will not be an impediment to the acceleration of effectiveness. Now, I did not have a chance to watch the earlier discussion from today yet, but given the makeup, it would not surprise me that some of the panelists might have suggested that this represents a reversal of prior Commission policy or weakening of investor protection. Colleen, by your reaction, did I get it right? Were there some concerns expressed? Now, in fact, the Commission has never had a policy of prohibiting such provisions. Our recent policy statement articulates, simply, however, that absent a clear congressional directive, the applicability of the Federal Arbitration Act was not overruled by the federal securities laws, and the existence of an arbitration provision in and of itself is not grounds for denying effectiveness under Section 8A of the Securities Act. This approach is consistent with judicial precedent and ensures that our rulebook is clear, transparent, objective, and predictable. To suggest otherwise is to mischaracterize both the law and the absence of any prior commission policy. During the consideration of this policy at the open meeting, I specifically raised the question of, could the commission, in fact, take the exact opposite position? In other words, assume that, and you probably heard, I suspect, or if not today, elsewhere, that there would be this parade of horribles that might occur should there be mandatory arbitration provisions in corporate charters with respect to shareholders' security claims. So, would the commission have the legal authority to issue a policy statement that specifically would say we would deny the acceleration of any registration statement should that company have charter provisions that would have a mandatory arbitration provision in it? And the answer was, from our staff, was essentially no. If the disclosure was adequate, then we would otherwise be engaging in merit regulation. And that was not authorized by the federal securities laws, and the public interest and investor protection standards need to be interpreted in that framework. Now, with respect to what you will be discussing shortly, artificial intelligence and the committee's recommendations and considerations, I just wanted to express my appreciation for the committee's work on this topic. I think if there has been a theme for the 2025 conference season, it has been artificial intelligence and its effect on the capital markets. So thank you for your involvement in this. As this has been a rapidly evolving area of corporate activity. As AI becomes more deeply ingrained and integrated into business operations, the need for material information by investors may very well grow. The committee has proposed that issuers define what they mean by artificial intelligence in their disclosures, disclose board oversight mechanisms, if any, for AI deployment, and report separately on the material effects of AI on internal operations and consumer-facing matters. I recognize that these recommendations are grounded in a materiality-based approach and are designed to fit within the existing disclosure framework under Regulation SK. Further, the committee's decision to build on existing disclosure items rather than propose a standalone AI regime is a pragmatic one that avoids unnecessarily structural complexity. That said, it is important to approach this area with caution. There are practical and conceptual challenges that merit further consideration. For example, the lack of a universally accepted definition of artificial intelligence could create interpretive and disclosure issues. Boards, management, and their counsel may struggle to determine what qualifies as AI, particularly when distinguishing between traditional automation and more advanced machine learning systems. Similarly, while board oversight is a critical governance function, mandating disclosures in this area may not always yield meaningful insight for investors, especially if oversight responsibilities are diffuse or still evolving. And while reporting on the material effects of artificial intelligence is a reasonable goal, it may be difficult in practice to isolate those effects separately and independently from regular business operations. Moreover, we must be mindful of the potential for regulatory overreach. Prematurely codifying rigid disclosure mandates could stifle innovation, particularly for smaller issuers that may lack the resources to implement complex compliance systems. A one-size-fits-all approach may not be appropriate in a space where use cases, risks, and maturity levels vary widely across industries. As we're required to by law, consider the committee's recommendations, our goal should not be to use the federal securities laws as a backdoor attempt to regulate AI. Rather, we must ensure that investors are not left in the dark about material risks and opportunities that may arise from the use of artificial intelligence in business operations and strategy, and to do so in a manner without being encumbered by prescriptive or duplicative requirements. The committee's work and efforts provides a forum for this ongoing dialogue, and I look forward to continued engagement on this issue. And so thank you very much for allowing me to spend some time at the end of what has probably been a long day. That's going to get even longer with your subsequent discussion. But as we bring this year to a close, let me just say I've really enjoyed working with a number of you, and particularly Brian. I do appreciate. I know we didn't do it before this meeting. Scheduling didn't allow, but normally, with the various subcommittee chairs and the rest of the leadership committee to have some ongoing discussions and dialogue. Thank you very much for all that you've contributed to this year. And if I don't see you later, wish you the best for the holiday season. And I very much look forward to working with all of you in 2026.
Thank you, Commissioner Ueda, and in particular, thank you for making the time after your long day and your red-eye flight. We appreciate it, and the remarks are well taken, and we will obviously take them under consideration. We will next move to our afternoon recommendation, discussion of a recommendation regarding disclosure of artificial intelligence's impact on operations. That discussion will be led by Alvin Velasquez, who's Vice Chair of our Disclosure Subcommittee. Alvin?
Thank you so much, Brian. Good afternoon, everyone. Good afternoon, Commissioner Ueda. Thank you for your comments as well. Today, I have the privilege of presenting to a recommendation from the Disclosure Subcommittee on the use or disclosure of artificial intelligence's impact on operations. The genesis of this project came from two locations. One was honestly my own interest, and scholarly interest in artificial intelligence and its impact on corporate governance, but also on issues related to my other scholarly expertise, which is labor law. But secondly, to consider what is a commonsensical framework within our existing securities laws. And to that end, we heard research I came across and that was incorporated into this memo that you have received was informed by what seemed like to be a dislocation, which is everyone was saying we should disclose artificial intelligence when it's material in operations, but we're not quite sure what to say. And so everybody was saying something a little bit different depending on, of course, the context from which they are coming from. The recommendation that was posted was slightly amended with some clarifying and conforming amendments, and that was sent to all members of the IAC that you should have. Those conforming amendments are just to make clear that the recommendations apply when material to a company. And so with that, let me give a quick overview of what the three recommendations are. The first is to require issues to adopt the definition of the term artificial intelligence. The second is to disclose board oversight mechanisms, if any, for seeing the deployment of artificial intelligence. And the third, if material, is to report separately on how issuers are deploying AI and the effects of AI deployment on internal business operations and consumer-facing matters. The reason why we chose this kind of metric is because it seemed like there was two very different areas of concern regarding artificial intelligence. On the one hand, I'll give a perfect example. I ran across an announcement that talks about Hewlett-Packard replaces 6,000 jobs nationwide with AI, $1 billion AI overhaul eliminates engineers and support staff. That is it's something that impacts internal operations. Right, but the real question is, how is that reported to investors? And so significantly, we said, well, hold on. How artificial intelligence is used specifically on product lines may look very different. And so there should be at least a little bit of analytical clarity there as we develop our thinking regarding artificial intelligence. And so the recommendation contains three very simple use case scenarios as examples that are illustrative of what we were trying to discuss when it came to external operations. And the reason being that hasn't been brought up as a defining kind of way of thinking about this issue. So first, the recommendation talks about, if material, medical industry participants could disclose whether FDA guidelines on high-risk machine learning-based AI systems impair or otherwise impact patient outcomes, again, if material. Secondly, if material, financial firms could disclose how much they are spending on developing AI platforms to inform investment advice that an advisor might make to a client as an R&D item. And third, if material, an airline who uses AI to inform pricing decisions for travel could disclose how much it's spending on developing the model. The idea being here that each case is going to be a little different. Each company is going to apply these things differently. These are just illustrative examples. So with that, and with the understanding that AI is rapidly developing, I want to go back very quickly to talk about the adoption of a definition. I feel like right now, if you try to get 6 or 7 technologists in a room and ask them to identify what is AI, depending on where they sit, they will give you very, very different definitions of what artificial intelligence is, either based on a definition from algorithmic technologies to large language learning models to algorithmic to agentic models. What this recommendation does is it remains technology neutral, but asks issuers to simply define the terms that they are using when they use the term artificial intelligence. And it provides examples that are already existing in statute or in agency guidance as defaults if they don't want to use a specific definition of the term artificial intelligence. We think that this provides very significant flexibility and allows companies to show my age in terms of choosing your own adventure, but to choose your own adventure in terms of how you define artificial intelligence. The board governance mechanism is something that came up because, again, the markets are showing uneven disclosures. And some companies are disclosing very detailed disclosures regarding their AI governance, and others are not. And for companies where it's not material or important, there's really not going to be much to say. For example, a company that is in traditional manufacturing that isn't using artificial intelligence much may not see that as something that's material. However, a technology company that is using AI all the time or is an AI forward company may have to say something about how they govern the use of their AI usage. And so we're just trying to provide some analytical clarity. I've already expressed talked about the distinction between external and internal operations. With that, I am very pleased to present this recommendation for a vote by the IAC. I want to thank my colleagues for all their help, those on the disclosure subcommittee, and as well as recognize some help that I got from a student of mine here at Maurer Law School, Philip Lin. So with that, I present the recommendation for approval.
Alvin, thank you for that outstanding overview and summary. Are there further questions or comments from members of the IAC before we go to vote?
Brian, I was trying to raise my hand, but I do.
Okay.
So
go ahead.
Oh, thanks, Brian. No, and thanks, Alvin. And I apologize to you. I know you emailed me a couple of days ago, just been a little swamped. But I know that you and I had a discussion about some of my points of consideration around the recommendation. You know, I'm still struggling, to be honest, because as you outlined, I do think, you know, I do appreciate you outlining how the technology is evolving. That's just the way that I interpret what you're saying. Artificial intelligence you're exactly right. There's a lot of, you just like asking accountants, you know, you're going to get 10 different answers. Well, hopefully not, but the problem that exists is, well, one of the problems I have that it finally hit me a couple of days ago, which is why I didn't respond, was in your recommendation, you call out generative AI, which is actually a subset of AI, right? So so I do believe, yes, that there needs to be some standard definition. The problem is when it comes to implementation across the board, because generative AI today, which is built off of large language models, right? These foundational models that there are 3-4 very large companies that which are not public. Well, take that back. One is, and the methodology of that kind of AI can create text, can create video, can create images, a number of things. The challenge with that methodology or that technique of AI today is that there are challenges in terms of how it's being implemented and also, well, how it's being adopted and how it will scale in by publicly traded companies and by private companies as well. So I'll point to just a couple of, I think I may have sourced a couple of references to you in an email, but to others, I'm most recently in October, there was an MIT report calling or outlining the lack of adoption in terms of AI. And that report was citing, it was interviewing CTOs from across the landscape. The other challenge is that there is in the AI space, there is a lack of not just adoption, but in terms of scaling and the use or the way in which AI is being used today may shift, and there may be something. I really appreciated the previous discussion on tokenization, because some of the same themes I have and some of the same concerns of how trading and issuing are done today and will change very, very quickly. So I don't know if and I apologize to others, because I know this is actually, I think, my only second investor advisory committee meeting. So I'm still getting my feet wet, so I'm not entirely clear on the process, but I was unable to respond to you, Alvin, but wanted to put these, provide these thoughts back to you.
Great. Thank you very much. And actually, Sergio, I appreciate you sending me that MIT report. I actually included a quote to that report on page 2 of the recommendation. So it was, I thought it was actually really useful. Happy to take other comments or discussion.
Hi, Alvin, it's Paul.
Hey, Paul.
Yeah, just responding to Sergio, if I understand your point, Sergio, I mean, the recommendation, leads with issuers self-defining what they mean by artificial intelligence. So if that, if it changes, it, they have the flexibility to define it the way they see it. And so I'm not sure that it's stagnant, and I'm not sure that the way there's some suggestions on how you might define it, but we're not trying to circumscribe how issuers define it. So it seems to me that addresses your point.
Yeah, no, if I can respond, Paul, no, it's yeah, I think, I guess, this being the other data point that I keep thinking about is we're right on the cusp of the 3rd anniversary of ChatGPT being released, right, by OpenAI. So the lexicon is the definite. Well, artificial intelligence has been around for a number of years, and my concern is that there are. I take your point. Again, where I'm struggling. I'm not as concerned about the definition. I guess it's how the companies look at, or at least assess, how they are implementing it across, operations and across products. So my struggle and argument is mostly with item 3, not so much item 1.
Rodney?
Hey, first, I just wanted to acknowledge and thank Christina for her work and her leadership for the past 3 years as investor advocate. And a number of others have done that already, but really appreciate it. My only regret was I only got to do 2 meetings, but you've done a lot to support and promote the interest of investors. Pleased to the team who worked on disclosure. I think you did some good work here. And so I'm supportive of the committee's recommendations because they offer the guidance of how to put it into disclosure while allowing a lot of flexibility for company and industry specific nuances. It's not overly prescriptive, which I think is one of the keys, but disclosure is one of the key things for the ability for the market to see what a company is doing and to determine long-term shareholder value. I think it makes investors have more information to do better decisions. I had some comments earlier about materiality. I appreciate that those were updated as late as last night. I think that's one of the big balances in disclosure, making sure it's meaningful in that sense. And that, really, I think, cleaned that up. And then last, and it's one of those things that, every time you put disclosure in, there's a cost to the company. And cost to companies are something I think you really have to think about when you do it. So I think one of the ways to think about that for the commission of the SEC and the folks is to see how it can fit into existing frameworks, such as Reg SK, which offers practical solutions and how to incorporate this without creating an additional burden other than the materiality side. So overall, I'm going to be very supportive and vote in favor. And again, Christina, thank you for your work.
Thank you, Rodney. Other comments? Questions?
Yeah.
Okay.
James.
Yes. Hi, Brent. Sure. First of all, Alvin, I appreciate all the excellent work that's gone into this report. I mean, I recognize that this concept, originated under an earlier SEC, right, and was derived from panel discussions that predated my joining this IAC. I would say that my general inclination is along the lines sketched out by Commissioner Peirce this morning, more of a principles-based disclosure regime predicated upon materiality, and that I have a general skepticism for some of these particularized, granular, prescriptive sorts of disclosure regimes that aren't unique to this policy recommendation, but that have been regularly coming forth from the SEC in more recent times. I also recognize that there's certainly some uncertainty on the part of issuers here. There's uncertainty about what they're supposed to do vis-a-vis AI and disclosure. That does, however, give me pause. I think along the lines of what Sergio was talking about. I mean, I remember when I was in law school, and my antitrust professor, George Priest, the late George Priest, was engaging in back and forth in the Wall Street Journal with my friend, the late Robert Bork, over whether Microsoft was going to capture the internet market through decision to attack Internet Explorer to its browser, right? And these things are evolving very, very quickly. And I worry about the unintended consequences of a sort of prescriptive disclosure regime that will create board committees and other such things and its own sort of sense of uncertainties. All that said, I do appreciate the focus on materiality that I think has been, from what I understand, has been added into this recommendation that wasn't necessarily there originally. I'm very hesitant, as I was at the last meeting, to vote no, and I won't be voting no on a recommendation that predated my participation. And even though I've been aware of this since September. Most of the work was already done. By the time it came across, my email and in front of my eyes. So I appreciate all the work you've done on this. I think it's complicated. I'm not sure exactly how the commission is going to act on it, but thank you for all the hard work. Thanks.
Thank you. Georgiev?
Hi, thank you, Alvin, for your hard work on this recommendation. I want to say that I will support the recommendation. I think it is very helpful if issuers are using the word AI for them to define what they mean by AI and how they're using it. And I think the illustrative examples centered around materiality are also very, very helpful. I think we could have done more here. I think, it would have been consistent with the SEC's mission to have a broader recommendation. But I think the recommendation that we have is very good, and I think it will be helpful to the market.
Thank you, George. John Gulliver, you're next, and then I see Paul Roy. You're on mute, John. John?
Sorry about that. So I just want, I wasn't expecting so much of a discussion before we actually voted. And I understood that we're going to be able to share our views as to why we're making our vote when we actually provide our vote. So is that still the case?
You can do either. I mean, we're having a discussion before so that folks can, hear the different views.
I'll just do that then.
Okay. Thanks. Paul?
Yeah, just quickly responding to James. I mean, maybe it's just me, but I don't read the recommendation as being prescriptive. I read the recommendation as food for thought for issuers. If you think about whether or not your use of artificial intelligence in the context of your business is material, and if it is, define it, make appropriate disclosures, and outline how your board is overseeing that process. I don't see that as a prescriptive requirement. That's my comment.
Okay. Thank you, Paul. Anyone else? I don't see any other hands, but I just want to make sure. Okay. Do we have a motion? Take this to a vote?
So moved.
A second?
Second.
Okay. I just want to make a note that if the recommendation is approved, and I don't mean to assume that it will be, but just a procedural matter, the committee would be approving it in substantially final form, as we have always done, or not always, but we generally do, with the chairman and vice chair of the disclosure subcommittee being authorized to make any non-substantive final changes to style and format and footnotes. All those in favor?
Aye.
Aye.
Aye. Aye.
Okay. Any opposed
To this proposal?
to this proposal, to the recommendation?
I'm opposed.
I'm opposed.
I'd like to share my views as to why too.
Okay, so it's John and who else?
Sorry, Brian, it's Sergio.
Sergio. Okay. And let me just finish the vote and we'll let you go on that. Go ahead. But any abstentions?
I will abstain.
I also abstain for the reasons I already articulated.
Right. So that's just make sure for the record we have that. That's Christina, Jim, anyone else? Okay. Let me go back to John so that you can give your remarks.
Thank you, Brian. So basically, I'm concerned that these recommendations are headed in the exact opposite direction as the commission. On Tuesday, Chair Atkins announced that a key goal of his as chairman is to reduce public company disclosure burdens to help grow our public markets. This is just 2 days later, and we are now recommending that the SEC increase disclosure requirements for public companies with respect to their use of AI, the most important technological development that we've seen in decades. These recommendations are also inconsistent with recent steps taken by other developed markets. I recently met with policymakers in the EU and Japan, and they are actively seeking to reduce regulatory burdens for the use of AI by public companies. They're doing so because they want their markets to grow, innovate, and be internationally competitive. and they understand that AI is fundamental to that objective. But my concern is not just that these recommendations are out of step with the SEC and other developed markets. My primary issue is that, in my view, these AI disclosure recommendations would not help investors. I'll briefly explain why for each recommendation. The first recommendation is that the SEC establish a requirement that public companies define AI when they use the term. This may sound easy, but it is not. I know many AI experts that struggle to define AI in less than 1,000 words, and they all have different definitions. The reality is that companies would have to either adopt boilerplate language or adopt widely varying definitions. These definitions would likely change from year to year or quarter to quarter. I just don't see how this benefits investors. The second recommendation is that the SEC establish a requirement that boards of public companies disclose their oversight practices for the use of AI. But boards already have extensive requirements governing their oversight of management, and these requirements apply to decisions involving AI when those decisions are financially material or impact risk management. In my view, new AI disclosure requirements for boards are likely just to further increase procedural burdens for them. The third recommendation is that the SEC require public companies to provide highly specific disclosures of how their use of AI impacts employees at their company and the company's customers. It's good that this is only required when the use of AI is financially material to the company. But unfortunately, I think this is an impossible task. Does the SEC really have the AI expertise necessary to determine what these new line item disclosures should be? And how is a company supposed to know the precise impact of AI on hiring or their customers? There are many macroeconomic and industry-specific factors that affect jobs and customers. In my view, accurately isolating AI-specific impacts would be a difficult guessing game. Public companies would expend significant resources trying to get it right, and they will face serious legal consequences if they get it wrong. The result is that these burdens and legal risks will discourage companies from going public and could even discourage public companies from innovating with AI. Unfortunately, I can't support these recommendations. Thank you.
John, thank you for your remarks. Is there anyone else that would like to talk?
I would after any dissenters.
Yep. Let me just make one note for the record. We received proxy votes in favor, voting yes, from Nancy Lamond, Amy McGarity, Gina Gale Fletcher. Go ahead, Alvin.
No, just one thing I realized that I had not mentioned in the overview. One of the recommendations that was in an earlier draft that ultimately was adopted by the SEC and therefore not needed to be in the draft as a separate recommendation was to create a task force on AI. And so we just wanted to recognize that the Commission is taking leadership on AI in terms of establishing an internal task force and developing expertise. And so that wasn't a part of the recommendations because as we were working and iterating on this, the Commission had already gone out ahead of us. And so I just wanted to acknowledge our appreciation of the Commission for that work.
Alvin, thank you again for all your hard work on this recommendation. The entire committee appreciates it, and we look forward to the Commission's consideration of the recommendation. Our next item of business are subcommittee and working group reports. We'll receive brief reports from our subcommittees. First, Andrea as chair of Investor as owner.
Thank you, Brian. We really don't have any developments to report. We were busy early in the year last year and have really just been weighing in and reviewing material from the other subcommittees. We do anticipate leading a panel discussion for the March meeting. We're currently working on that. Thank you.
Thank you. James, as on behalf of the Purchaser Subcommittee.
Thank you much, Brian. First, I'd like to thank Christina for her service to the committee, and I wish you well in your future endeavors. There's not much to report, in part because of the government shutdown. We did not have meetings. However, Purchaser Subcommittee did prepare for and deliver the corporate governance panel discussion today. Thank you much.
Thank you very much for that. Andrew, market structure.
Yeah, so following our panel on tokenization today, we will be taking some more time to discuss what we learned today and We'll be holding a number of meetings every month until the next public meeting. So invite all to participate as you can.
Thank you, Andrew, and also John for moderating the tokenization panel today. Finally, on subcommittee reports, Christine for the disclosure subcommittee.
Yes, we spent most of our time working on the recommendation we just considered, and we'll next be working on a recommendation following the foreign private issuers panel from September, hoping we'll be able to talk about that one soon.
Thank you, Christine. We're at a point of closing remarks and then our adjournment, but I do want to mention and take the opportunity as chair to specifically extend my deepest gratitude to our investor advocate, Christina Martin Provita. As you've all heard, today is likely her last meeting that she'll be attending with us, as she'll be leaving the SEC at the end of January. She served as the director of the Office of Investor Advocate since January of 2023, and she's a statutory member of our committee. Her office advises the IAC and each of its subcommittees and has been an invaluable resource to the committee. On a personal note, Christina, I will miss the interactions that we've had over the past 3 years, your contributions to the committee, and I wish you all the best in your future endeavors. Thank you, Christina. We couldn't have done what we do without you. In conclusion, whoops, I'm sorry, Christina, I cut you off. I'm sorry.
If I could just take a
Yes.
minute to thank all of you and all of your predecessors. There are quite a number of individuals that have worked on this committee during my 3-year tenure. Some of you are here today. Almost 20 have at least 15 have left previously. I've known some of you since before I joined the SEC. I've had the privilege of working with some of you through our work with the law school clinics. I've enjoyed meeting with some of you at conferences. So I've gotten to know each of you beyond the space of this advisory committee. Brian, I do serve as a statutory member, but in my tenure, what I've really appreciated has been the time that I've been able to spend with each of you and that my team has been able to spend serving you as your support. Much more so than as a peer on the committee. I have greatly benefited personally from the very, very thoughtful dialogue that each of you engage in. I think the commission and the public does not have an opportunity to observe the very complex work that goes on at the subcommittee level, but my team and I do have that privilege because we support you. And it never ceases to amaze us, the patience and degree of respect that you each bring to very difficult issues from very different perspectives. Don't always agree. You are always able to come to some consensus and produce incredibly insightful recommendations. I would like to say, especially to you, Brian, and to the executive committee, to Colleen, to George and Paul, how much I have enjoyed meeting with you regularly. I am very sorry this will be my last meeting, but I will for sure be tuning in March. And I don't know where I will be just yet in that moment in time, but maybe I'll come in and see you in the multipurpose room and enjoy it in person together. So with a great deal of gratitude for all that I've learned from each of you and for the enormous time sacrifice that you each make as volunteers. The commission is very lucky to have you serving the SEC and serving the investing public. And with that, I'll see you next time.
Thank you, Christina. Thank you so much. That marks the end of our December 4th meeting. I would like to convey my thanks to Mark Sharma, Adam Moore, Charles Kwan, the rest of the SEC supporting team for their hard work. I want to thank everyone on our committee. It's been a long day, but I think a very valuable one. And again, Christina, we will miss you, but as a member of our committee and working with you on a day-to-day basis, but we look forward to staying in touch. Thank you so much for everything you have done for our committee. Thank you. And that concludes our meeting.